Good morning. Thank you for joining us for the June 7th, 2024 meeting of the Chicago Teachers Pension Fund Investment Committee First Friday meeting. For the record, I am President Jeffrey Blackwell of CTPF Board of Trustees. I've been asked to chair this meeting by our committee chair, Jacqueline Price Ward. This meeting is being held in person at our office at 425 South Financial Place. The Investment Committee is a committee of the whole and includes all CTPF trustees. A quorum for this committee is 7 trustees on site. Please note the following. Access instructions for remote attendance and instructions for in-person attendance have been posted on the fund's website. All participants, please wait to be recognized by the chair before speaking, and please limit discussion from each trustee to 3 minutes. Please note that for our staff and trustees to focus on the business of the meeting, we will not be responding to messages from participants using the Zoom chat feature. Please forward questions to memberservices@ctpf.org. We'll now move on to public participation. Okay. Is she in?
Hello, can you hear me?
Yes. Good morning.
Good morning. Good morning. I was going to say good morning to the chair, Trustee Price Ward, but I see she's not present, but I'll still say good morning to all the fiduciaries present today. Hi, my name is Tina Padilla. I am the Pension Advocacy Group representative. I come again to ask that the Communications Committee be reinstated, possibly as an ad hoc committee until November, when the governance body is installed and the chairs of all the committees are assigned. I will refrain from listing all the many ways that the lack of having this committee has negatively affected members. I will leave the list because of time, but I would like to remind the trustees of the historical events after communications have been cut off. In short, remember, the first rule of warfare is don't let them communicate. One of my biggest concerns is how our documents, meeting documents, are being archived. I remember being very, very happy when we got board docs, thinking that would be our archive where members can go and look at previous meetings or get prepared for the meetings coming up. And when I went into board tops to prepare for today's meeting, it was not, I didn't have any information other than the names of the presenters, and it had their names and it had real estate credit. So when I posted to remind members that there is a meeting today, that's what I posted, real estate credit and the names of the, but later I look and I saw the summary and this is debt. I would also like to remind people how risky this type of investment is. Thank you very much for your time, and I continue to be very happy and glad that we can work together to restore this gold standard of defined benefit for all the service that teachers have provided throughout their working years. Thank you.
Thank you. Is there any else? No more.
I have my hand up.
I'm supposed to take questions.
Just quick question. Do we have everything?
Excuse me, Maria. We can't take questions during public participation.
I'm sorry?
We can't take questions during public participation.
I mean, not what?
We can't take questions during public participation.
I just,
Explain it.
I'm serious, and Tanya complained, Ms. Trustee Woods last time by here. No, my only question was that accurate? Everything is on board docs or not?
Joe and Dan, can trustees ask questions during public participation?
I mean, I generally, sorry about that. Maybe I'll put that back a little bit. I don't have a problem if it's if it's in reply to the public participation. Yeah, but
Actually, Joe, you may not be aware that there are rules of debate that we have that the board adopted
Right.
a couple of years ago, and indicates that any participation by trustees should occur later in the meeting and not.
Right. Just want to make sure we're safe.
yeah,
Could you-
that's right. You're right. You do have those rules of debate.
Okay.
Sorry about that.
Not a debate.
Yeah, but I knew there was policy. That's why I asked.
Yeah, just so you know, you guys don't have that drop ceiling like they do over this, your voice bounces as well.
Okay. That takes us to roll call.
Trustee Beza,
Present.
trustee Barajas, trustee Blackwell,
Present.
trustee Nelson, trustee Ochoa,
Present.
trustee Price Ward, trustee Riley, trustee Rodriguez,
Present.
trustee Vincent,
Present.
trustee Washington,
Present.
trustee Woods. Thank you.
Well, since we don't have a quorum, we don't vote to approve anybody participate remotely. So we just go straight to the presentation.
Automatically elevated.
Okay. Fernando?
You just go straight to the presentations. Well, I think it's in your script actually, but
Yeah.
yeah, you don't have a.
Good morning, trustees. So just as a reminder, the purpose of First Friday is to provide a deeper dive into a sub-asset class or an asset class that we identify. It's also to introduce the committee or board, as well as our staff and our consultant, to new managers and their strategies. Ideally, we try to bring in MWBE managers to give them a chance to present directly to our board and perhaps gain experience and practice in doing so. The purpose, again, is not to make an allocation decision at the end of this meeting. So the focus of today's presentations is on real estate debt investing. Simply put, real estate debt is lending to the real estate industry or lending that is backed by some type of real estate-based collateral. The fund does currently have about 100 million already invested in real estate debt through 2 managers, but we thought the time is right to discuss the topic and bring in new ideas and managers. Another good way to understand real estate debt investing is through an example. One example is residential real estate. So when you and I buy a home, it's rare that we buy with 100% cash. Usually we put down a down payment, and that's our down payment is considered equity. The debt that we take on, that is real estate debt, and it's usually provided by a bank or lending institution. And that mortgage, again, is considered real estate debt, and it's backed by collateral. In the case of commercial real estate, developers and investors in large real estate properties also don't purchase with 100% cash. They borrow usually the rest, and usually the term for these loans is not 15 or 30 years. So they're much shorter in term, unlike in buying a personal home. The opportunity in real estate debt investing recently comes from 2 main factors today. Number one is, as we all know, interest rates have gone up and it's becoming more expensive to borrow and refinance, and not to mention the ability to finance that debt depending on which corners of real estate you've invested in. It's no surprise that commercial office is distressed these days. Also, traditional lenders like banks have largely exited the commercial real estate lending space due to financial regulation. So today, we think we've curated 4 managers who invest in a variety of real estate debt. These managers span from newly formed to almost 10 years in the industry. All are MWBE managers. And with that, I'd like James to bring in our first guest presenter. Unless, Tony, do you have anything to add for real estate debt?
Just real quickly, when I look at this group of managers, the real estate debt market is not just one little thing. It's not just, homes. It's not single family housing. It's not just commercial It's all of these things, and it can be done in a variety of different ways, with more leverage, with less leverage, in a systematic way, in a very fundamental way. So when you're listening to these managers today, I would, in your head or on your notes, try to pick out the few points that are like, this is what they're doing and this is where they're good at, because you're going to see all of these managers do it a different way, and they're in different sectors of the market, and they're doing it in a different structure in their portfolio. So it's a very interesting market, and there are often pitfalls, and the key is figure out where to be, and manager selection is very important. And it is a great opportunity. So we can bring the managers in now.
Just a quick question. I notice at the top, we have executive summary, which says real estate debt. So each time, because I do not always attend the first Fridays, I'm not able to. So each time we do the first Friday, do we have a specific topic or asset on there?
We more and more we're doing it that way, Trustee Rodriguez. In the past, it's been a combination or a hodgepodge
Right,
of
that's what-
managers, but we're trying to make them more thematic so that it's memorable for you, so that you don't walk away feeling like, oh, I saw 4 managers, but I can't remember what the topic was all about.
Yeah, my only concern would be on that is how long people are on waiting lists. If there's other people, other managers that want to present, they've been on a waiting list 6 months or 8 months, or I don't even know
Sure,
if it goes that
yeah,
long.
yeah.
And then if they're in this particular category that you've selected, who selects the category?
So staff does. And in terms of our setting expectations with managers, when we talk to them prospectively about First Friday presentations, we don't really say a specific date, and we don't promise that they will be, first in, first come, first serve. We want to be timely with what we bring to you, because there may be managers that are completely out of favor, and if we bring them to you, it may not be actionable, and you may never see them because it's not something that we would want to invest in. But from their standpoint, they got to present, but it may not be of any value to us to learn about the subject that they're presenting. Again, nothing to take away from the information that they can provide. It's just they may be out of favor, and also we're not trying to pick winners right now. We're just saying, I think these are some of the timely topics, and especially in some of these corners of alternatives, there are new MWE managers that are incepting every day that we think it would be timely to bring them to you.
Just change their word. They're not in favor. That's it.
Sure,
But
sure.
Thank you for the explanation.
Okay,
Thank you.
you're welcome.
Good morning and welcome to the Chicago Teachers First Friday. With us today, from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, our Chief Investment Officer, Fernando Vincent, our consultants from Callan, Tony Lisuzo, and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Whose voice was that?
Thank you. Good morning. Thank you, trustees, staff, Cowan Consulting Firm, for including me in today's presentation, in today's educational forum. I have long wanted to participate in First Fridays, and I'm honored to have the opportunity to have some of your time this morning. My name is Karina Williams, and I founded my own investment management firm, Caro Investors, late last year, after well over 22 years in real estate finance. My firm, Caro Investors, is based in Maryland, although I grew up in Washington, D.C. And it's a credit-focused asset management firm. However, throughout my career, I've invested in both debt and equity. However, I have chosen to focus my firm on debt for 2 reasons. One, because I have extensive experience in debt, but also because I really believe that the market opportunity over the next 4 years at least is in credit. So I look forward to sharing more about that with you throughout the presentation. In addition to, or in my spare time, I should say, I do 2 other things other than Carol. One, I chair the endowment for the national setting of the United Church of Christ. And secondly, I serve as an independent trustee of Care Trust Real Estate Investment Trust. I'd like to focus your attention on page 6 of the presentation materials. My firm will have a 7-person team, and that team will be 100% dedicated to Caro's flagship investment strategy. Some of those team members are people that I've worked with before. I've spent my entire career investing on behalf of public pension funds in both discretionary funds as well as separate accounts. And if you see at the bottom of that page, I plan to have the requisite third-party institutional service providers that will support the requirements that pension funds like yourself have. One thing of note is that I will have some service providers that are diverse owned, but all of my service providers will have diverse teams because it's something that I've pushed for throughout my entire career. If you turn your attention to the next slide on page 7, I want to spend the heart of my time talking about my investment strategy. I plan to invest in 3 different types of debt: senior, structured, and distressed debt. Each of these 3 different strategies have different levels of risk. And I want to walk you through the 3 different types and examples with each of those. And I'm going to use a really simple math just to make it easy to understand. Let's start with 1, senior loans. In that instance, I would try to find someone who's buying let's say a retail center, and let's say they're buying it for $10 million. In this instance, I would provide a first mortgage that's perhaps $6 million. And then the group buying the retail center would put in the $4 million of equity on top of my loan. This loan type is the least risk because I have really strong collateral in that first mortgage position. Said differently, $4 million of value would have to disappear before you start to have risk of your investment. The second strategy is mezzanine debt or preferred equity. Some people just call this gap financing. But let's take the same example of the same center. It's a $10 million center. However, in this instance, I'm not going to provide the first mortgage. That person buying the center, the $10 million center, might go out to a life insurance company and get $6 million from that life insurance company. And then the group buying the center will put in $2 million of equity. Okay, so that totals $8 million. There's a gap of 2. I fill the gap. And that's what's called, it's either mezzanine debt or preferred equity, or you can call it gap financing, but I fill that gap in between the first mortgage and the $2 million of equity. That strategy is a little bit riskier. Why? Because you can see in that example, I have $2 million versus the 4 that can get eroded before you start to have real risk. But it's a really interesting time to invest in that particular gap financing instrument today. And I'll get to that reason a little bit later in my presentation. The third example of an investment strategy that I'll focus on is distressed debt. And I want to note that this is the riskiest strategy I have in my fund. And for that reason, I've limited it to 20% of the fund. Using the same example, same $10 million real estate center, in this instance, something has already happened to that retail center. And so now what we should assume is that the bank has foreclosed on it and it's sitting in what's called their REO department. An example of what I would do is I would go and buy that asset from the bank directly It's called REO, or real estate owned. But I would buy it at a steep, steep discount to what it would cost to replace that investment. And those investments can generate very high returns. But I would buy it, you know, in that instance, let's say that first mortgage that that bank had put on was 6 million, I'd be buying it at 6 million, but most likely less even than the $6 million note. So those are the three investment strategies that I'll focus on: senior, structured, and distressed debt. A few other things I want to mention about my strategy. So I'm targeting a $400 million fund size in a closed-end vehicle. I'm targeting a return of 11 to 14% net and a cash yield along the way of 6%. So I'm not just total return focused, I also want to distribute returns along the way. That reduces your risk. I'd like to focus on the following property types of real estate in terms of what I'm lending on. I'd like to focus on multifamily, on industrial, and retail. Particularly retail, where I feel like there are strong tenants that are investment grade tenants, high quality tenants with good performance. And then in terms of markets, I would like to say that I'd like to focus on keep on keeping on markets. So not markets that have explosive growth, but markets that have steady growth. And I really like to focus on locations where demand remains steady because, you know, even through good cycles and bad cycles. So I really look for institutions like healthcare, big healthcare, universities, government, but things that stay steady even in bad times. So some of those markets are in big markets across the country. Some are smaller for that reason. But again, I just want steady growth. Why? Because I want to make sure that for the period of time in which I've made a loan with your capital, that the value of that asset is going up over time. So if you turn your attention to slide 9, now is where I want to actually talk about why I think it's such an interesting time. The CIO obviously mentioned some of his reasons for why it's an interesting time. I want to elaborate a little bit and give you my own opinion. As I mentioned before, I've been investing in both debt and equity on real estate for 2 decades. But I believe, having invested in debt over 2 decades, that it is the best time I have seen in 20 years to be a lender. In my opinion, debt is actually less risky than equity today. And more importantly, you can achieve the returns that you would achieve in equity in debt. So why is that? 3 reasons. 1, as the CIO mentioned, interest rates have absolutely gone up. They've actually almost more than doubled. If you look at where rates were pre-Fed rate hikes in 2022 to where they are today. That means that, frankly, the cost of debt has gone up. And that means I, as a lender, can charge more. And the borrowers, frankly, expect to be charged more. Secondly, if you think about the commercial real estate business, we use the most leverage of almost any other different types of assets. We use a lot of leverage, and we typically rely upon, frankly, regional banks for that leverage. I'm sure many of you have seen what's been happening in the regional banking market, but the increased amount of regulation really has translated in them not lending as much. And that has created a really large opportunity, particularly in what I would describe as the middle market. And that's where I focus, and I've focused my whole career, is on transaction sizes in that $5 to $50 million range. And there, I would say, is an even greater scarcity of credit liquidity in that middle market. And so that when there are fewer banks lending and fewer frankly, all institutions lending. What that means is there's a much greater demand for people that can lend, which means you can both charge more, but also take less risk. When I mean less risk, what I mean by that is that the same loan I would have made, before the Fed started increasing rates, I would have to have taken more risk on the real estate, where today I can take less risk on the real estate and do it with better, stronger borrowers. The third reason why it's an interesting time is because there are a lot of loans coming due, 2.8 trillion to be exact. And so what that means, using our same example that we talked about before, that $10 million retail center, a couple of years ago, it had a $7 million loan on it. That loan is coming due. Today, they're going to get a $5 million loan. What does that mean for the owner of that real estate? They've got a $2 million gap. I fill that gap. So when we were talking earlier about why it's such an interesting time for that mezzanine debt, preferred equity, or that gap financing capital, it's because all of these gaps are being created as these loans mature on real estate values that have come down with lenders that are lending less. So there's gaps everywhere. And my intent with my strategy is to fill those gaps. There are other ways, however, that I reduce risk that is more fundamental to who I am as an investor and who I've been as an investor over 2 decades. One, I focus on lending on real estate with cash flow. Secondly, I've always actually invested in an unlevered way, meaning I'm not borrowing money to lend the money. I've generally not been that person that's engineered into the returns. Thirdly, I would say I describe myself as a fundamental focused investor, and I'm very research focused. You can even call me a research nerd, but I like to use data on markets, and I look at various trends to make sure that I'm lending on real estate where the values could go up versus go down. But I also use just common sense. I put my tennis shoes on and I go to the market and I walk these properties. I walk the surrounding properties. I talk to people in the neighborhood that live in the neighborhood, that work in the neighborhood, so that I really understand the markets in which I'm investing. Because again, I want to make sure that when I make a loan, that the underlying asset, the underlying commercial real estate, is going to go up in value versus down in value. And I have to spend that amount of time really kicking the tires to do that. Fourthly, is I monitor the loans very carefully after I've made them. And a very high attention to detail on asset management. What's also interesting is that in this, when you do invest with a firm that is considered smaller like mine, you will have me seeing every asset that would be invested in with your capital potentially. So lastly, before I open it up to questions, and if you turn to slide 11, I wanted to spend a little bit of time talking about the DEI and ESG efforts.
Excuse me,
May I continue? Oh,
You're
sorry.
fine.
Okay, thank you, Trustee Rodriguez. While it's not a mandate as part of my fund or firm, I do believe that a very high percentage of my borrowers will be diverse-owned firms. Why? Because I've cultivated relationships with these constituents over my career. Secondly, and very importantly, Caro Investors is named after my parents. Caro is short for my mother's name, Carolyn. And frankly, the quilting behind that derives from a place in Alabama where my father's from called Gee's Bend. And they instilled incredible values in me and sacrificed greatly such that I could even be in a position to talk to you today about my investment management firm. And so those are the values with which I will lead Caro from a corporate standpoint. And that means 3 different areas of focus for me. Obviously, there's a scarcity of people that look like me that own their own institutional investment management firm. I believe it's actually basis points of $70 trillion, meaning not even 1% of $70 trillion. So there are three areas in which I want to focus, because if you can imagine, it's been incredibly difficult for me to be in a position to talk to you today about an investment management firm that I own versus work for. One is spend. I pay a great deal of attention, as I mentioned before, on who I spend money with in terms of the vendors. And I will absolutely be focused on making sure that I spend money with vendors that are diverse owned or have diverse led teams within their organization. Secondly, interns. If you look at the picture, the second row are my two interns from last summer, one from Morehouse College, the other from Howard University. I absolutely intend to continue to have interns. And we'll focus on HBCUs. Thirdly, and very importantly, I intend to have a percentage of the profits of my fund go to support educational scholarships at institutions initially where my parents attended, which were Morgan State University and Howard University. That ends my presentation. Thank you so much for your time today. It has really been an honor to be able to talk to all of you about my career and my firm, and I open it up to any questions that you may have.
Thank you.
So I just want to make sure I understand this, right? So on page 7,
Yes,
so I understood the third part the clearest. So I'm trying to picture it from, not from your point of view, but the point of view of seller or owner of the building. So
sure.
can you explain those first two with that in mind? Like you're talking about why it's in good investment into these three and.
Yes. You mean from, oh, I'm sorry. Are you on, you said you're on page 7 or page 8?
7.
Page 7, okay.
The three types of.
Oh, the three
property.
types, yes. So, and you said you'd like me to explain it from the vantage point of the person borrowing
Yes.
the capital?
Yeah.
Excellent question. Thank you, Trustee Ochoa. That we've been in what I would call an expansion cycle for real estate, where values have just continued to go up, 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 right? Until COVID, boom, right? Came back up again, right? But then once the Fed started hiking rates in the spring of 2022, values have continued to come down pretty significantly. I would say anywhere from 15 to 30%. In the case of office, it could be 50% or more. And frankly, that'll be ongoing. We borrowers, the borrower, has faced what's almost been this low interest rate environment forever, right? So, but the problem is that has changed. And frankly, I believe that we're going back to kind of where we used to be before we had this really low interest rate environment forever. And that means a higher rate environment for longer. So what I would say to you is that these borrowers are starting to realize that there's a reckoning occurring in real estate and that they are going to have to, frankly, pay more, but frankly, what people used to pay, back in the 80s and the 90s, right? Before this huge expansion run happened. So from their perspective, if they have a loan coming due, they're going to have to pay a higher rate to anybody, okay? My firm is just providing another alternative. My fund is providing another alternative other than banks, life insurance companies. And frankly, there are not that many alternatives for borrowers to go to today. And so, but yet we still do need for development to occur, right? In multifamily, in retail, in industrial. So I would just say from their perspective, they're starting to realize that when they want to go and get that construction loan or some sort of senior loan to buy a retail center or buy a multifamily asset, they know that they're going to have to, frankly, pay more today. But that means higher returns to you. The second example, from their perspective, that's an interesting one. The reason why I think this is so compelling right now, this gap financing, where we are the dark blue, that's where your investment is, the middle of the stack. I think it's interesting from their perspective because let's say they go to a life insurance company that can give them, that can charge a little less than what I'm going to charge. That they still though have a gap, right? Where they can't fill that whole thing with equity from their pocket. So I'm coming in and filling that gap. This is actually a very, there's a lot of demand for this gap financing. It's not just driven by people looking to buy retail centers. It's also being driven by what I described earlier as that owner has their loan coming due, and that loan was made at the peak of the market. So it was a bigger loan, right? It was a $7 million loan. Life insurance company today is saying, I'll give you $5 million at this higher cost. And so they need my capital, frankly, to continue to own the real estate, or they're giving it back to the bank, which is why I also have distress as part of your strategy, because there are going to be some assets where that gap is so wide, they're giving it back to the bank, and there's an opportunity for us with your capital to buy it from the bank. And that's the third chart, even though you didn't ask about it. Does that answer your question, trustee?
Thank you very much.
Thank you. Yes, trustee Vincent?
I'm sorry, is your focus going to be a commercial or residential in terms of real estate?
Primarily commercial real estate. So, but for commercial for me would include multifamily real estate, industrial real estate, and retail real estate. I didn't mention this, but I started my career in the retail group of an investment bank, and I'd like to think I know retail pretty well at this point. And I think it's an area where I can showcase some of my strengths.
So, so I guess I'm not fully clear. So would it only be, I'm sorry, are you doing initial mortgages or just purchasing debt?
Most of my fund, excellent question, actually. Most of my fund, I'm going to be really the lender originating first mortgages, or what Trustee Ochoa was asking me about, originating mezzanine, that second position, that gap, or preferred equity. In the case of the distressed debt, that is the instance where I might actually buy a loan that's not performing from a bank or buy it from their REO department. But that is capped at 20% of the fund. Why? To reduce your risk, because it's the higher risk strategy.
Quick question.
Yes, Trustee Washington.
Good morning. Thank you for this presentation. It was, I like it. I'm a realtor, so I like stuff like this. So to Trustee Vincent's point about the types of investments, specifically, so I get commercial and multifamily and stuff like that. So would these be multifamily as in like investments that are building like townhomes, apartment rentals? So for me, full transparency, I'm all about putting money in communities where maybe some of that has been lacking. So that, because affordable housing is a very critical part of the market that I feel like is slowly slipping away. And so like, is that like true affordable housing? And
Yeah,
I don't consider affordable housing over based on the this or the that the government's, no.
yeah,
I mean, can somebody that's making 40 or
Yeah.
$50,000 a year
afford it.
afford to be able to
Yeah.
pay this rent and not have to eat cat food
Sure.
and Vienna sausages? You know
Yeah.
what I'm saying?
I understand, trustee Washington. I will be very honest with you because I can't
Mhm.
help but be honest. I'm not an expert
Okay.
at what's called, just what I would describe as low-income housing tax credit, affordable housing. It's
Mhm.
100% affordable. I don't feel that that is my expertise.
Mhm.
With that said, have I invested throughout 2 decades in projects with up to 20% affordability? I have. Have I invested very recently in a townhome project that is build for rent attainable? Again, not 100% affordable. I understand what you
Mhm.
mean, but it is attainable. And I have been looking frankly at different projects to do stuff like that in, you know, different parts of the US, including in my backyard in Prince George's County.
Mhm.
You know, I mentioned that I was based in Maryland. And so you're right, there is a need for that throughout the country. I just don't necessarily feel I am equipped to or have the specialized skills to do that LIHTC affordable housing, but I will absolutely look at that. I think there's another area that's also important, which is retail is often very also underserved in
Mhm.
certain parts of our
Mhm.
country and zip codes. And that is an area where I do believe I have some expertise and could potentially focus more on. I hope that answers your question.
It does. Thank you very
Thank
much. I
you.
appreciate it.
Thank you for the presentation. Very interesting. I was wondering if you could real quickly, just using that chart on 7, just talk about the spreads that you're getting in each of these sections, because traditional fixed income spreads are incredibly tight right now, even with, you know, the higher interest rate environment, absolute level of rates. Could you just talk about what kind of premium you would
Absolutely.
expect to get beyond the
Yeah.
liquidity premium?
Sure. No, that's an excellent question. I probably should have addressed that earlier. You know, I would say in the senior loan total return that I would expect would be frankly mid to high teens gross returns. You know, in a senior position, at least on a construction loan. Why? Because there are not a lot of groups providing construction loans today, but people need them. So that is absolutely not what a construction loan rate would have, or return would have been several years ago. On the gap financing or the mezzanine debt and preferred equity, I would also say, you know, because I'm looking again for real estate that has cash flow to it, I would say those are generally more mid-teens, but you can potentially get close to higher teen returns as well on that product. On the distressed debt, that should be the highest returning because it's the highest risk. So I would look to get a gross return on those investments that would be high teens or even more. Why? Because that's the highest risk. I hope that answers your question. I could break that out into specific note rates, but I'm not sure if we have time for that level of detail. But it hopefully that does demonstrate that it's my belief that you can achieve equity returns in debt today. Oh, sorry. Trustee.
Well,
Joe.
So part of what you said, I guess I'm going to look at Tony behind you.
Okay.
So, because at the presentation at the Callan convention, I think you guys mimicked part of what she said about the correction in the real estate, and she's cutting right into that correction and taking advantage of the correction. Do I remember a presentation exactly on that?
I think it's spot on. I mean, the market that you are in, and you've identified it as this is a good time for it. It's right in line with what was presented. And you know, it's recognized, as we said, find good people to do it.
So I guess the competition to be a lender in there. There's going to be so many loans coming due that there's room for a lot of people, but you're hoping you can get a significant chunk of those.
Absolutely. And part of the way I can get that chunk, Trustee Ochoa, is because I have been working in the middle market space for almost 20 years. And frankly, I'm going to try to focus on borrowers that I have already transacted with before. Why? Because I want to do everything I can to be successful, because it's my own firm. And I need to be successful, not just for myself, but for others that look like me that may come along later.
Oh, go ahead, Jeff.
No, I said,
Oh, thank you.
Thank you so much for your time.
I apologize. There is a, just so everyone.
Jeff, I had one question.
Oh, I'm
Trustee
sorry.
Price, Barajas, and Riley have joined online.
Okay, we have a question from a trustee that's participating online.
Yes.
Go ahead, Jackie.
Okay. Forgive me if you've already answered this question, but I wanted to know if you have raised funds already, and I may have missed that because I was just able to log on, or are you in the market right now?
I am about to be in the market, trustee, and I expect to have first closing at the beginning of the fourth quarter of this year.
And that would be fund one, or what is that?
It's my first fund. However, I have
First fund. Okay.
for my firm that I own. However, I have what's considered two or attribution rights for two other fund vehicles that I worked on at prior firms.
Okay. All right.
So
and
I'm deeply experienced in this type of investing.
Okay, thank you. I appreciate that. So, and the size of your fund right now you're developing?
I'm targeting a $400 million fund size.
Okay. Thank you so much. I appreciate that. And forgive me if this question has been asked. I was just able to get in.
No, it wasn't asked. So thank you so much for your question.
Okay, you are quite welcome.
Okay. Just making sure nobody else has their hands up. Okay, thank you. Thank you again for your presentation.
Thank you so much for having me.
Thank you. Thank you. That's what she did for like 20 years.
Morning.
Good morning and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, our Chief Investment Officer, Fernando Vincents, our consultants from Callan, Tony Lasuzo and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Good morning.
Good morning.
Can you hear me? Yes, you can. Thank you. Good morning. My name is Donna Sims Wilson, and I am the Chief Operating Officer of CA Capital Management. On behalf of my colleagues and myself, thank you very much for the opportunity to present our firm to you today. CA Capital Management is a minority-owned firm focused on mortgage credit. In addition to generating top-tier investment returns, we are equally proud that the work we do greatly reduces foreclosures and helps people to stay in their homes. Please allow me to introduce my colleagues as you turn to page 3. Adama Kah is our Chief Executive Officer and Chief Executive Officer and CIO. And prior to founding Kah Capital Management in 2018, he was responsible for Freddie Mac's $130+ billion distressed mortgage portfolio. Adama was responsible for the portfolio management, helping to design the technology, and most importantly, going out into the marketplace to create demand for what are called non-performing and reperforming mortgage loans. And because he had to stratify the degrees of delinquency of this large mortgage portfolio, he coined terminology that is still in use today, terms like spotty pay and clean pay, and he was even the founder of Freddie Mac's securitization programs that are based on these types of mortgage loans. To Adama's left is Chandra Bhattacharya, and Chandra Bhattacharya worked with Adama at Credit Suisse First Boston, and they were on the strategy, RMBS, AMBS strategy research desk. And over time, Chandra rose to become the head of that desk before going to Pretium Partners, which is a large purchaser of both non-performing and reperforming loans. And at that point, Chandra was Adama's Adama's client. And then last but not least, Doc Gose, who is not with us today. Doc was on the management committee of Freddie Mac. He also, during his 20-year career at the firm, was responsible for the $850+ billion portfolio. He was treasurer of the corporation, responsible for all debt issuance, and even spent time as a manager of all modeling and analytics. And with that, I will turn it over to Adam.
Thank you, Donna. And good morning, and thank you for having us today on a beautiful day in Chicago. Kah Capital is a minority-owned firm. We're focused on U.S. mortgage credit. The U.S. mortgage market, as you all know, it's quite large. It's a total size of $14 trillion, which provides a lot of attractive opportunities across the entire spectrum. So we invest across the entire spectrum in mortgage credit. A sweet spot for us within that space is the what we call these high-touch distressed, semi-distressed mortgage loans. And the reason for that is there is a substantial amount of supply of those assets in the billions of dollars that we see every year. And many of those programs, as Donna mentioned, I created and developed those programs from scratch at the GSEs after the last crisis. So there's a lot of supply. The competition is limited, and the barriers to entry, especially in our sweet spot there, is relatively high. And there's attractive opportunities to deliver good returns and also help many at-risk families. And a lot of these opportunities really kind of show up from the standpoint of, the last crisis, just seeing how many families essentially fell through the cracks, unfortunately, quite often unnecessarily. So building those programs, it really brought in terms of, okay, there's this opportunity here. So really our strategy is really clearly to deliver good returns to investors, but also do it in a way that is very responsible. So our do well and do good strategy is really how we approach our strategy. And in our strategy, these two goals are not in conflict with each other. And the reason for that is we're able to acquire these assets at substantial discounts to their intrinsic value, which allows us to really work with many of these at-risk families and find a solution that are both economical for investors, as well as help many of these families not only keep their homes, but build generational wealth for their families. And that is increasingly and even more important today, given that home prices are much higher today. mortgage rates are higher. So it's even harder for families and first-time homeowners to get into homes. And even and unfortunately, if they happen to lose that home, renting is actually more expensive than what they will pay. And we'll have to talk about some of that in a bit. So so we launched in 2018 when I left Freddie Mac to start Capital. And if you go to slide 4, that summarizes our funds and fund performance to date. And we've been able to deliver on these dual goals of doing well for investors and doing good in terms of helping at-risk families. So our fund target returns are 15 to 20%. Fund 1, which we fully exited, delivered in excess of the target. So we launched Fund 1 in 2018. It was $150 million in equity. And we're able to deploy all of that capital within a year. So which speaks to the size of this market and the opportunities that are there to both do well and do good and deploy this capital. And our returns, we're able to deliver net IRR of 21%. So these are fully realized returns. So we fully exited that fund. So we're equally, which we deliver very strong numbers, and even compared to our competition and the benchmarks, that reflects that, and we'll talk about that in a minute. But we're equally proud of the outcomes in terms of what we were able to achieve with families. So for that portfolio and the assets that we had the control in terms of managing those loans, we're able to reduce foreclosures by 50% relative to the source where we actually bought some of those loans, some of which were from the GSEs, Freddie Mac and Fannie Mae, which were created those programs. And clearly we know those institutions do care about keeping families in their homes, but we're able to outperform what they are doing by reducing foreclosures by 50% relative to what they're doing. But we didn't stop there. It doesn't stop there. We also reduced the pipeline of potential future foreclosures by 50%. That is actually looking at the borrowers that are 180 days past due or more. If you reduce that pipeline, then there are just few of them that may eventually end up into foreclosure. And these outcomes, we track also the outcomes across all families. So when we are doing this, we try to help anybody who is at risk, irrespective of whether you are a minority, whether you are white or from any other background. But we also track those outcomes in minority communities and in low-income communities of all races. And we use those definitions of those areas based on what the regulators of the GSEs define those areas, FHFA. And what our results also demonstrate that not only are we reducing foreclosures by 50% across the board, but in those neighborhoods where there's low-income and minority communities, we're also getting similar, in some cases even better outcomes. And that is very important because having sold billions of dollars of these type of assets to many investors across the board, from my old seat before I started Capital, some of the most sophisticated investors, many of them had the wrong mindset around that low income or minority communities, they fall behind their deadbeats, which really, I didn't see that then, and we're not seeing that in our portfolio. And you can even argue that for many of those families, that equity that they have is even that much more important to them, both in terms of the amount of their wealth that they could transfer, but even what it means to them of being able to own a home. So that is something that actually resonates very well with us. So in Fund 1, so the performance of 21% and those outcomes, very strong, which if you look at slide 5, that shows the performance, how that stacks up relative to other benchmarks. So during that period from when we first dollar of investment to exit, so the chart on the left-hand side, that's the gross returns, which is 23%, which compared to the S&P 500 was 15.2 on some of the other benchmarks. So our performance was very strong relative to those. And so if you can go to slide 6 very quickly, sorry, slide 7, which actually shows how their fund's performance ranked relative to other real estate debt funds of that same vintage. So our fund was number one compared to versus all other funds. So again, we're able to deliver these returns while still having the positive impact. So we're currently on Fund 2. If we can quickly go back to fund slide 4, sorry. So which we did the first close in May of 2022 and final close in October 2023. The size of that fund is 236 million. And to date, we've already deployed over 70%, more precisely 75% of their capital. Again, speaks to the opportunity that's there. And we think the entry levels are even better now than when we invested in Fund 1. And there as well, the returns for that fund are also quite positive. So the gross returns for that Fund 2 to date is 12%, 12.2%. I think there is a lot of upside in the returns, not only return, but also the opportunity to help many of these families stay in their homes. So we're currently pre-marketing Fund 3, because we think these opportunities are there to really do well and do good. So with that, I'll pause, and my colleague Chandra will talk a little bit about how we actually do what we do.
Thank you guys for taking the time today to talk to us. So I'm going to talk briefly, I know I don't have a lot of time, the investment strategy, a brief overview of the housing market and the market opportunities today, and how we generate these returns in terms of generating the alpha, right? So as Adama said, the US mortgage market is pretty big, $14 trillion, right? So even in the best of times, people sometimes have trouble making payments on their mortgages. It could be because of, health, job loss, death, divorce. Is extremely strong. Is extremely strong today. So now the question is, why is that so, right? So if we turn to page number 14, you'll see that on the left-hand side, we show the total amount of equity, homeowners' equity, that, page 19, I'm sorry, page 19. I'm sorry, my bad. The total amount of equity for US homeowners is $32 trillion. That's at a record, right? And on the right-hand side, we show the cumulative home price gains that the US housing market has had since January of 2020, and that's close to 46%, right? And as a result of these, what has happened is that, and currently the mortgage rates are very high and the prices are very high. So as Adama pointed out, the affordability for these homes is very constrained, right? So in terms of our strategy, in terms of getting these distressed borrowers, buying their loans at a discount, and stabilizing these borrowers over time. What do I mean by stabilizing these borrowers? By stabilizing, I mean that these borrowers are currently delinquent or making one payment and stopping and so on and so forth. But once they become current and stay current for 12 months in a row without missing one single payment, we call them stabilized. And once a loan is stabilized, the price of that loan goes up by double-digit points in the market, right? So given the constrained affordability, these borrowers, if they're able to retain the equity, which is substantial at this point of time, that's another way of making these housings affordable for these borrowers, right? So the other reason why home prices are strong, and we anticipate that these are going to remain strong, is if we go to slide number 24. Here, the bars show that the difference between household formation and housing completions. So that is running at a negative. And right now, the US housing market has about 5 million shortage of homes to stay in. And that supply squeeze is essentially giving rise to this very strong home price performances, despite during COVID, right? And so essentially, for instance, we have had about 1.7 million household formations last couple of years. But home building, the housing completions rates have been only about less than 1 million. So that gap is increasingly becoming higher and higher. So as I said, the housing fundamentals in terms of price is very strong. And what does that do for us? What that does is that amount of equity that brings into these loans is even if something negative were to happen economically or even for that loan, this equity basically saves us in terms of losses, right? So that's the overall strategy. Now, the question is, how do we do these things, right? So our investment strategy and our asset management strategy, it is all very, very algorithmic. We have built a platform which basically looks at the behavior of loans, and we have trained this model by looking at about 70 million loans over the last 25 years and their payment behavior. And with the help of this model, what we are able to do is we are able to give tailor-made solutions to borrowers. Now, how do we do that? If we turn to page number 9, what we are showing here
I'm
is
sorry, what page? Because there's
page
one-
number 9.
Okay, because there's one page on there and it was a half page, and then see it's jumping, so it's on our part. The screen keeps on jumping. I know you noticed that.
Yes.
Thank you. It wasn't just me. Thank you for,
Yes.
you can get that fixed, Executive Director.
Yeah, that's the page, yes, page 9, yes.
Thank you.
So what we are showing here is borrowers' payment behaviors over the last 3 months, and this data is from our portfolio, right? So there are 3 classes of borrowers that we show here. On the left-hand side, we show the payment behavior for borrowers who are 60 days or 2 months behind on their payments. The middle section focuses on borrowers who are 4 months behind on their payments. And the right-hand side is for borrowers who are deeply delinquent, 6 months or more past due on their loans, right? Now, if you go out into the market and say, oh, I've got a loan that is 4 months behind on their payments, people will normally say that, okay, simple, borrower hasn't paid in 4 months. But that's not necessarily true. If you dig deeper into the data, you will see that many of these borrowers are actually trying to make payments, but are not being able to catch up. So what it shows here is the green bar shows the share of borrowers amongst the 120 days, which is the middle section, 120 days past due borrowers, who have made at least 2 payments in the last 3 months, and that's more than 60%. And if you go to the left-hand side for borrowers who are 2 months behind on their payments, that's close to 80%. So despite the fact that these borrowers are 2 months behind on their payments, 80% of these borrowers are making 2 or more payments. What is that telling us? That is telling us that these borrowers are willing to pay, but they cannot just catch up, right? And the payments, they can afford the payments, but they have missed 4 or 5 payments in the past. They just cannot catch up and become current on these borrowers. Now, these borrowers require a different solution compared to the other class of borrowers, which is shown by the orange lines. The orange lines represent borrowers who have made absolutely 0 payments in the last 3 months. And that's about 20% for borrowers who are 4 months behind on their payments. And as they go deeper and deeper into delinquencies, and that's become 70+% of the borrowers stop paying completely once they are 6 months or more past due, right? So what does that tell us also? What that tells us is that you've got to intervene early to help these borrowers stabilize themselves, right? And these class of borrowers who have not made any payments in the last 3 months, it is quite clear that they are unable to afford the payments. So what we do is we can restructure their mortgages to reduce their payments so that they can become current and catch up over time. On the other hand, borrowers who are making 2 out of 3 payments, at least 2 out of 3 payments, they can clearly afford the payments. So what we do to maintain the economics also is that we will just roll the missed payments for these borrowers and put it to the end of their mortgages. And now they are current, they don't have to pay any late fees and so on and so forth, right? So we have tailor-made solutions for different classes of borrowers.
Yeah, so I think that's a great point. I think, and even to kind of illustrate an example of just how something like that could work, let's say, so an example of a Fund 1 portfolio, a pool of loans we acquired, where one of the loans that we acquired at the time is a loan in rural South Carolina, someplace in Ellery, South Carolina. It's a low property value. Clearly, some of those rural areas' property values are lower, and when we, by the time acquired the loan, the servicer who was on the loan and the owner of that loan, they were already in the process of foreclosing on the loan. And even though we bought it at a lower price, but just going through the foreclosure process, they're fixed costs. Would have already likely not going to make money on it anyway. But then another issue was that this family, that's the reason why they were behind, the property was owned by senior citizens who were retired. So they had actually rented the place to another family that they were looking to eventually sell it to them. Unfortunately, the spouse of the family died in a car accident. So clearly they had better things to worry about than put between their liquidity and all other issues. So we said, okay, just using our algorithm, we're able to identify what's going on here and through the notes. We said, okay, we figure out a way to say, okay, stop the foreclosure process. Let's figure out a solution that will reduce the payment for this family for a limited time amount for some time until they resolve their issue, and then they can actually get back on track. So this was pre-COVID. So we did that, and over the years, and even through COVID, they were still paying. And fast forward, at some point, not only did they recover, but they actually paid it off. So essentially, it becomes a win-win. They get to stay in the home, keep that home, and hopefully eventually they end up buying the place. But also as an investor, on a loan that you bought at maybe 50 cents on the dollar, you get back 100 cents on the dollar. So it becomes a win-win. So again, say that our strategy of doing well and doing good are not necessarily in conflict with each other. That's essentially what we mean in terms of those opportunities. And we think there's a lot of people that we compete with that actually really don't start from that mindset in terms of how you approach it.
Yeah, just another point is the class of securities and the class of loans that we invest in, right? So these assets are income generating right from the get-go. Unlike in other private equity funds where there's a J-curve of negative income initially, we throw out coupon income right from the get-go. So that's also a different asset class, and that's a kind of attractiveness of this asset class. No, I'm done.
I have a question. So good morning. Excuse me. So you all buy the loans basically you buy the loans from whatever mortgage company is, saying they're not paying, we over this, take this debt off of our hands. And then you all have a servicer that then works directly with
Yes.
Okay.
We basically oversee the servicer because you can tell them what to do, but they may not necessarily do everything that you tell them to do. So again, through this algorithm, we monitor very closely what the servicer does on a daily basis, right? We monitor the data and we tell the servicer what they're failing to do because we're monitoring this data every night.
Yeah. So I mean, I would to add to that, and some of it might sound crazy, but at Freddie Mac when the portfolio 130 plus billion, I had like about almost 900, almost 1,000 services in that portfolio. I didn't know there were that many services in the world. And what was very clear was and the GSEs, they're big, they have very strong and so forth, and they have a lot of leverage. But these services, I mean, even with all of that, there is a lot of, even just because they have a contractual obligation to do X, doesn't mean they do. So our algorithm, when we talk about algorithm, a lot of people talk about technology and so forth. I mean, we think technology, for the sake of technology, is useless, but technology has to have a purpose. So we really use our technology to do two things. One, to make sure that actually we are to the real oversight. What they're doing, quite often we tell them, they give us their loan data feeds every day. But even with that, we're telling them stuff about data that they're telling us. Make sure that they're doing what they're supposed to do. But also the second part of it is just the one that Chandra was just saying in terms of use the algorithm to say, okay, identify which of these borrowers, two borrowers that are 4 months behind may not be the same. One that is paying every month, but is 4 months behind and paying late fees is different from one that hasn't made a payment at all. The one that is paying, maybe they have a child that actually was that had a medical situation or short-term job loss. Just getting those payments to the back, they stop paying late fees, which wasn't coming to you as an investor, was just going into the servicer's pocket. And now you also reduce the likelihood that they fall further behind. So that is really how we use technology. That is all informed by experience that we've had working on this type of assets and working with services and knowing some of their challenges.
So thank you all for the presentation. Adama, can you talk about big picture? Because you're not buying single loans, you're buying lots of loans. What does the analysis look like in terms of which lots you buy?
Yes, so these pools, that's a great question. So these pools, quite often when they're sold in large pools that are very geographically diversified across the country. So it could be anywhere from 200 million to 500 million pieces. I mean, and sometimes these large offerings could be, let's say, $1 billion or $2 billion into pools of 200 to 3 to 500 million. So we'll purchase these assets, then settle them into a securitization, and we are retaining the higher yielding subordinate and intermediate classes. And with that, we also have the servicing control whereas we're able to direct the services in terms of one, picking which servicer we want, because clearly we know who's good at what. And then two, design in terms of how we contract the servicing and the fee structure. That way, not to create disincentives for them to get good outcomes. Because what we see is some of these investors will pay these services more for borrowers who are behind. So guess what happens? They want to get more of them behind, that way they get more fees. So we charge them, it's a flat under fee that they make. So essentially, the more of the loans that they get current, which cost less for them, they'll make more money. But we don't want to pay them for actually getting, for not getting many of these borrowers back on track.
Thank you.
Just another side of your question is, as Adama said, there are a couple of pools, right? That comes in like 3 or 4 pools in a $2 billion total offering. And so the way we look at it is there are many pools which are clean. That's not where we focus on. That is basically bought by money managers or insurance companies and so on and forth. We focus on these pools where there's a lot of distressed component in there. And that's what, and the way we kind of look at these pools and price them out is through the same model. We run, simulations for 400, 500 paths for each loan and get the anticipated expected cash flows. And that's how we kind of, on a loan by loan basis, we price these assets.
Thank you.
Based on what you're just saying, so you guys are actually going out working with the individual homeowners that no,
there's a servicer in between.
Okay, so you're giving them.
I'm only talking to the servicer, telling them what to do. We don't speak to the borrowers.
But you give them the information that they need to go out and make those
all
connections.
the information and I tell them what to do.
Okay.
So we are getting direct data feeds. So we get information about even when their conversation, they record that. So we're able to track all of that.
With the goal of keeping people in their homes.
Yes.
And is this regional? Are you, because I noticed you're East Coast based, or are you nationwide? Or are you just in
The
a
pool of assets is nationwide. It's
Okay.
geographically very diversified so that, there's no geographical risk so that we kind of diversify it all across the nation.
Mhm.
But our offices are in Washington, DC.
Okay, good to hear. All right, thanks.
Trustee Ochoa had a question. I see trustee.
Yeah, well, one, just the first thought is, sounds great, like to differentiate like between these and make a calculated solution for each to help them. And part of me just says, why hasn't anyone done this before? The part where I was trying to figure out was when, in the case where you reduce the loan, is there a loan after that, or what happens when you reduce the loan and it
The
doesn't
payment,
cover it?
you mean when I reduce the payment. So it's the same loan. What we do is we restructure the loan's terms. So we will say, okay, now your payment goes from X to X minus something, right? And it'll stay that for the next 5 years. And then it will go up gradually over the next 5 years to what your payment was before the restructuring. It's the same loan, it's the same note, same mortgage, but terms have been changed.
Okay, thank you.
So, excuse me, to that point, that's different from well, I guess it is, well, it's different from a traditional modification, whereas the negative, or the arrears are like packaged as a second mortgage, or, like they tack it to the end.
No, we
So
don't. do
you all basically, you recapitalize it
that. Yes.
basically,
Yes.
and then, spread it out over the.
So we can
long
extend the
time.
term.
Yes.
So that, your payments come down, so on and so forth. So we could do all of that stuff.
So this may be a silly question, but I'm gonna ask it anyway. So you all buy in bulk, and is there not an arm? So I'm thinking about like how many people are going through these issues that you're talking about with needing, they've fallen on hard times, life happened, and they're working with a bank that's just being obnoxious, and they just won't work with them. And now they're at risk of losing everything that they've put so much into, which is why so many people will then just stop paying, because now they got to try to prepare to move on or do something else. So now they're stacking their coins and watching the money that they've invested just dwindle away. Is there a way, even in your process, where consumers could come directly to you, or is that a strategic model that you all have considered, would consider, where consumers that are really in trouble could actually come to you directly, as in, hey, buy my mortgage, or can I refi with you, or can we restructure, or something like that? And that may be like that's what's not random, but there may be pie in the sky. But yeah.
So that's a great question. I mean, first, there's some legal aspects to that, right?
Okay.
Right? So the legally, there is a license requirement to actually interface directly with the borrowers, right?
Say that one more time. I
There's
missed it.
a legal requirement in terms of licensing to interact directly with the borrowers.
Okay.
And we think even with what we're doing, being one step away actually gives us a good visibility around because we're able to design certain specific waterfalls around how they work with the service. Yes, it has to comply with the CFPB rules, but also we have flexibility around how they interface with the borrowers. So even after all of those things that we say, okay, delegate to them, even if all of those fail, before the loan goes to foreclosure, the loan comes to us again. So we're able to find customized solution if we can do that, right? So we're able to, that's a key aspect to that. So in terms of, and to reiterate in terms of the modifications that we do, yes, so yes, we structure the loan. At no point, even after we target payment reductions that the borrower can afford. Even after the borrower stabilizes, at no point in the future will their payment go back to anything more than what it was before the restructuring.
But I think also you're asking, and correct me if I'm wrong, you're asking, is there a way to extend our processes to just the general mortgage market?
Ding, ding, ding.
Okay.
That's it.
Okay, so with that in mind, I'll just say very briefly, and then Adama can expand on it, is that, as I mentioned before, he came from Freddie Mac.
Mhm.
And so he is still very much in contact with Freddie Mac and with the regulators. And over the last year and a half or so, we have been having conversations with the regulators because they have said, we wish everybody thought the way that you did, because, Fannie and Freddie have laws and regulations about trying to keep people in their homes, but unfortunately they're not being followed. And so the answer is, in short, in working with the regulators and with Fannie and Freddie, if they choose to hire us, we will be able to extend our processes. But for right now, the only way that we can work with more mortgage loans is if we have more capital to buy more loans. And so at this point, we are at 200. Of course, I'm doing my job, sir.
I'm here for it. I love it. But that's a very valid point. So thank you.
Thank you.
Can't add anything to that.
Price Ward and Riley you have on there, sir.
Any other
I
questions?
think there's somebody right there.
Yeah, somebody online.
Oh,
Is that me?
Yes, go ahead, Jackie.
Price Lloyd? Okay, thank you so much. I was looking at page 5, and I just wanted to get a explanation of how you are how the strategy is, how you with using the S&P 500. Can you give me an explanation of that?
So I think there was some.
Yeah, can you just repeat the question?
It's on page 5
Yes.
in the booklet, and I was explanation of what are the benchmarks for this strategy. I see you have S&P 500, you have Bloomberg, you have 10-year treasuries, and mortgage. Thank you.
Yes, yes, I think if I understand the question in terms of how do we benchmark the fund? So we benchmark it 2 ways. So one is that page 5, and then the other one is the page 7. So the page 7, the page 5 here, what we're showing here is how does our performance stack up versus other places where you could have put in money. One is the stock market, and the other is actually looking at high yield bond index, and that is compared to what as a proxy for other private credit, because our strategy is more private credit like comparison to that. So which was 4.7% for that index, and then clearly you could have put your money into 10-year treasuries. How did that perform that period? And then the mortgage REIT, so essentially that is other investors that are investing in mortgages. So how did they perform? So we're able to actually outperform different places where you could have put in your money. And then slide 7, that just shows based on Preqin, which they created this benchmark. So they look at all 2008 vintage US mortgage debt funds. And based on that, our fund was number 1 compared to all 2018 vintage funds. Does that answer your question?
Yeah, I so it's categorically. So based on, is that what you're saying, is by category? So and on page, hold on. Excuse me, y'all. Okay, so and you mentioned page 7. So you said that you were rated number 1. Now this is across all of these benchmarks.
So these are the other funds that are our 2018 vintage that invested in US real estate debt.
Okay. That invested in real estate. Okay. I think I understand what you're saying, because I'm just looking at all of the benchmarks, and that is by category of what was invested in, correct?
Correct.
Okay. All right. Thank you.
Thanks, Jackie. Mary Sharon?
Yes, I have a question about the borrower is going through different whatever. What happens to the interest rate that they were originally charged?
So in case of when the borrower is making payments, right, the green bars that I talked about, where they're making, say, 2 or more payments in the last 3 months, in that case, their payment remains the same. All we do is we take the missed payments and say, okay, you don't have to pay them now, you will pay it at the end, right? So that they can keep making payments of what they're making and become stabilized. On the other hand, when we restructure the loan, the payment comes down, and it could be to their current mortgage rate that is on the loan. It could be the term, and it could be, a couple of other levers that we can pull to reduce the payments. So it can be one or many. I mean, if the borrower is already paying 2% mortgage rate, there is not really much we can do in terms of the rates. What we can do there is increase the term, because see, most of the borrowers that we have in our portfolio, they have stayed in their homes for 10 to 14 years on an average. And so essentially they are very attached to the communities. They want to stay, right? So, but it may be that they have already received a modification in the past and they're 2% mortgage rate now, but they are again going through some trouble. So in that case, what we can do is increase the term of the loan and thereby reduce the payment. The ultimate thing that we have seen is the success of these things depends on two things. One is how much equity the borrower has in their house, which gives them the willingness to work with the servicer and stay current. And the other is how much are you reducing the payments? But if you give them a payment relief, that really helps them in sustaining the payments.
Yeah, so the point is not about as much about the rate, it's about the payment. So if a borrower cannot afford the payment, then we'll target payment reduction of up to 20% that they can afford, and then stays there for 5 years, and then gradually goes back to what the original payment was. And if a borrower can already afford the payment, we don't change the payment, but in reality, by moving the payment to the back, in reality, you reduce their payment, because in addition to the payment they were making, they were paying about a few $100s in late fees every month. So as a practical matter, you're reducing their payment and keep getting them back on track.
John.
Thank you for the presentation. Just real quickly, Fund 1, obviously really successful. You exceeded the targets on return. Fund 2 looks like it's tracking well. You're targeting kind of similar 15 to 20 in Fund 3. Can you just compare the environments? Is this a good time to be doing this? And what would an environment where you would do less than the target, what would that look like?
Well, to your first question, we think it's a fantastic time to invest. For the reason being, the entry levels today are much better, both in terms of dollar prices at where we're acquiring these assets, because in part because interest rates are higher today and spreads are wider. So that's one component. The other part of it is, as Chanda mentioned earlier, homeowners have a lot of equity, a lot more equity today. So between 2000 to date, home prices nationally are up like almost like 46%. So what that means is it provides much more downside protection from an investment perspective, but also to the point you made about those borrowers, conditional on actually being able to engage them, they are more willing and have a greater incentive to work with you because they want to keep all of that equity. So we think being able to enter at higher, better yield. In fact, the investments that we invested in Fund 1 and exited at over 40% gross return, that in Fund 2, because we exited those in more like late 2021 when prices were at their peak and interest rates were their lowest. And we're buying essentially we've bought similar type of investments in Fund 2 at yields that were way better entry levels than when we were invested in Fund 1. And by the way, it's the same borrowers that are underlying those loans. Clearly, they have a lot more equity today.
Just a simple thing, but like if you look at these distressed loan packages that we kind of have bought both in Fund 1 and Fund 2. So back in Fund 1, when we were entering these, the entry prices were like high 80s, right? And then these prices went up above par, like 102, 104, 105, and we exited at that time, of course, right? Those prices for similar pools right now is in mid to high 70s. So yes, it's a very, very attractive time, and the market is big enough so that we can find assets very easily.
I mean, in reality, there have been, again, echoing Donna, there have been actually some investment we actually had to walk away from because just not enough capital. And we closed second fund in October 2023. We've already deployed 75%. So we're being selective on passing on certain investments, more because of the capital. But the more capital we have, the more of this we can buy at these levels, and hopefully the more families that we can help stay in their homes.
Okay, thank you. Thank you all.
Thank you. Well, thank you for having us.
Thank you very much. We appreciate the time. Thank you.
Put me to sleep. I'm okay. That drink.
I have a question.
Go ahead.
Yeah, we're starting to run over time. We're running 15 to 16 minutes on each presenter. Timers keep on going off. This last one's because people kept on asking questions and we have an agenda, we get our time. So what's the policy, Mr. Hurtado? You make the policy, we have everything mapped out and we're not following it. And also, we have two trustees, if we approve them for being,
Can I
you
address?
know what
the-
I'm talking about?
So for the remote attendance, you didn't have a quorum, so we weren't able, there was no vote on the remote participation. So you're not actually taking any action. It's just here for informative presentations.
Okay,
I'll let Dan address, I'll say what I have to say on the time. I know you have a timed agenda, but
right,
it's
because
also,
we have
it's
another
not,
meeting.
it's
in
not,
there. Yeah.
you don't have to, if you go a little bit over, that's really at the will of
Yeah.
the board, quite honestly, from my perspective.
Yeah, because I don't want to shortchange anybody else on their time. If we go 15 minutes for somebody else, we should
Right.
give everybody the additional 15 minutes,
But
just to be fair. Thank you.
Dan,
What
let
do
me
you
ask,
think, Victor?
Dan, since we didn't have a quorum, we didn't vote on the actual start time and end time, it wouldn't matter, right?
Yeah,
Go ahead.
right. But the control of it is not with the attorneys, control over the timing.
Okay,
The
thank you.
schedule is set. and
No,
it's up-
because
it's up to the
regular
board.
meetings, I would have been told, we got to move the agenda. We got to move the agenda. Marie can't ask a question. I just want to be fair to everybody. They know it's true. It's yay, right? That's the way they do it. That's the way they play.
Good morning. We're ready, James.
Thank you. Good morning and welcome to the Chicago Teachers First Friday. With us today from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, and joining remotely, Trustee Price Ward, Trustee Riley, and Trustee Barajas, our Chief Investment Officer, Fernando Vincents, our consultants from Callan, Tony Lasuzo, and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Thank you guys very much for having us. So I'm Denny Howe, and this is Adrian Garcia. We founded ARC 70 Capital. And what we're here to talk to you guys about is a really underappreciated portion of the credit markets that we've been able to invest in and scale in over time. Oh, yeah, apologize for that. So to talk a little bit about what we do at ARC 70, we allow affordable housing developers to develop and preserve affordable housing at scale across the United States. And so at ARC 70, over time, we've become the largest independent investment firm in investment grade real estate credit that finances affordable housing across the country. In terms of where we are as a firm, today we've raised multiple closed-end funds. In the affordable housing space, we manage $1.3 billion of equity capital, but that's allowed us to do over 43,000 units of affordable housing across the US. And that's had a real impact on a wide variety of communities because we have done over 270 deals covering 33 different states. In terms of how we kind of grew the firm, we have pretty traditional finance backgrounds, but both Adrian and myself have deep experience in the affordable housing space. So how I got into the space is I started a real estate development firm focused on affordable housing. And so I did everything that was required to obtain state tax credits, bonds, et cetera, to really build up a real estate portfolio within the affordable housing space. And so my perspective is that of an operator in the affordable housing space. And then Adrian came into the space really as an asset allocator, but I'll let Adrian walk through his background.
Thank you everyone for taking the time today. So I'm Adrian. I actually grew up just 20 miles southwest from here at Evergreen Park. So I grew up in the south side and went to high school here, but I actually moved over to California to graduate from UC Berkeley. After that, I spent 5 years of my career focused on the alternative investments industry, working in the private equity, the hedge fund space, where I learned more and more about investing. And in 2010, I took a role at Google, where I was investing their capital. And so I actually initiated Google's first affordable housing investment program, where we were going to invest $1 billion into affordable housing by deploying capital primarily on these investment grade senior mortgages that's tied to affordable housing. And we were deploying it across the country. So while I was working at Google and I was deploying capital there, Denny was working that of an affordable housing developer. And so we got together and launched ARC-70 in 2017. And since then, we've really grown our volume, our capacity, originating affordable housing, 43,000 units all across the country. And so where we are now is we want to continue growing that strategy by investing in affordable housing, which has been an underappreciated asset class, even though this asset class has been around since 1986. There's no private capital investors that's focused on affordable housing, because currently what's been historically, what you've seen is you see investors. The investors in affordable housing have been banks, insurance companies, GSEs. So we've really pioneered bringing in private capital investors here in affordable housing.
To talk a little bit about what we're actually investing in, what types of properties these are. These are properties that are financed in part with the low-income housing tax credit, which is really the federal government's flagship program for creating affordable housing across the country. The reason why it's been underappreciated over time is because it's a complicated area to underwrite. If you take one of these deals to a bank, I think oftentimes their investment committees are biased against affordable housing. They don't truly understand the asset class, but ironically, they're the primary source of capital that finances affordable housing across the country. If anyone's gotten a mortgage here, you can sort of understand that it's a little bit hard to work with a commercial bank. Sometimes getting access to your own money is hard at a commercial bank. And so what we really do is we understand affordable housing deeply. We have a lot of experience across the country with very complicated deals. And so we understand how to underwrite these transactions. And oftentimes for an affordable housing developer, the problem is not the mechanics of the deal, but really the complexity of bringing in capital, because they're getting a tax credit investor. They could have some state and local funds, but the senior mortgage, which we're investing in, is oftentimes a driver of what allows that deal to become economically viable for that developer. And so what we do is we bring understanding, ease of use to the marketplace, and we're able to really allow these developers to scale up their developments, to enter new markets and develop high quality housing that has a true rent restriction in the marketplace. If you look at around the real estate landscape, people will call things affordable housing that are not really affordable. They don't deliver a true discount into the market. It may just be naturally occurring affordable housing, which is not which is priced at a discount for other reasons. But what we're doing is we're preserving existing affordable housing with a true rent discount and allowing developers to build high quality housing, because we're taking a complicated and fragmented real estate credit area and bringing it to private investors. And we've been able to really do this at scale and continue to take market share from banks by delivering true value to the marketplace and allowing these developers to develop this high quality multifamily housing.
And just to point out some information regarding our portfolio and just the demand for affordable housing. So in our portfolio of 43,000 units, the average wait list to get into these affordable housing properties is 3 to 5 years long. So it's very difficult for tenants to get in. And that's why we've ramped our volume of trying to get as many units and as many of this type of investments possible, but there's just not enough. So for example, there's 19 million households in the country that qualify for affordable housing. Since 1986, there's only been 3 million of these units built. And in a good year, you're getting 100,000 units. And so really, of course, I know we're talking a little bit about what we're providing in affordable housing, but more importantly, our target returns are actually attractive. we target mid-teens returns, but have achieved higher across our funds in the past. And so not only are we able to generate these type of returns, but we're also scaling, adding more affordable housing units in the country every year.
Yeah, and just to talk about the returns that we're able to generate at the fund. So, I think affordable housing has been misunderstood and really underappreciated by the investment community, specifically on the credit side. So the way that we're able to generate these returns is we're able to deliver a very reasonable cost of capital into the marketplace for these affordable housing developers to allow them to make these properties viable. But how we're able to generate the return is we take what's a very complicated and fragmented real estate credit area, we simplify it and pull it, and then we're able to then access the municipal credit market to obtain a lower cost of capital. And that's how we're able to get the higher returns that you're seeing in the fund. And so what makes ARC-70 unique is not just the fact that we invest in affordable housing. I think affordable housing has a tremendous amount of data that shows that it's uncorrelated, that there's huge demand for the housing, but how we approach investing in this area is unique because we work with developers directly to understand their deals and to underwrite the deals. But then what we do is we create a portfolio of these investment grade mortgages that we then take to the larger capital markets, so the securitization markets. And that market has a much lower cost of capital that these developers traditionally are not able to access. And so what we're doing is we create value for all the stakeholders. We create value for the developer because we make their deals viable. We are able to underwrite their deal and really finance their deal faster than they otherwise would be able to. We're able to generate value for our investors because we're taking that complexity, simplifying it, and then accessing what is already a very large portion of the investment landscape that just doesn't understand affordable housing. And so what makes our strategy unique is really the vertical integration of what we do, directly working with developers, holding the underlying mortgages, and then being able to work with really large and sophisticated developers to then underwrite these deals at scale. And that's really how we're able to generate the returns at ARC-70. I think another thing that really allows us to be unique is our focus on affordable housing. This is a very difficult area for investors to underwrite. The collateral's different, the real estate's different, and a lot of investors in this area, they've tried to get into it, but they don't truly understand how the underlying properties work. And it's been difficult for them to build a portfolio within this area. Whereas for us, we've really built up a team that is focused on affordable housing. We've spent a lot of time working together. And so Adrian and I have been friends for 17 years. We didn't plan on coming into the affordable housing space, but there was a need for what we do. And I think it was also a very underappreciated area of the investment world. And so the firm really came together organically. And you see that really kind of across our team as well. So we have subject matter experts that have expertise in affordable housing in areas from where sourcing, warehouse banking, securitization, hedging, et cetera. And so I think the pure play development of our team has been a real advantage for us in the marketplace and has allowed us to scale where big investment funds have not been able to.
I think in terms of, I know you've mentioned uncorrelated, and just to give some data in terms of why this asset class is uncorrelated to what we've seen. So the average foreclosure rate in affordable housing is 0.02% per year. That's the lowest in the real estate asset class, about 1/30th compared to other multifamily market rate properties. And the big reason why it's uncorrelated to that market is even in the depths of the Great Recession, occupancy rates never dipped below 96%. Because what you have is a high quality affordable housing property with a substantial discount to market rate rent. So for example, if we had a property where the market rate rents was $1,000 in our portfolio, these properties are charging $600 a month for rent. So that's a substantial amount of rent discount, which really helps the tenants and the communities around that area. But more importantly, that explains why the average wait list to get into these properties are 3 to 5 years long. Tenants can't afford to get kicked out of their affordable housing properties because where else can they find a high quality property with amenities that offers that type of discount to market rate rent? They have no other option. And so one thing that's interesting about affordable housing is, during my time at Google, when we were looking at the average tenants and how long they typically live in these affordable housing properties, we didn't see tenants moving, like the shortest amount of turnover we saw was 9 years long. So there are tenants that get grandfathered in and stay in this affordable housing properties. And that's why that demand just continues to build up higher and higher, because it's not as if these tenants are necessarily moving out. There's just not enough being built. And so I think what we're able to capitalize on here in ARC-70 is we're providing that type of solution for developers to provide that financing so that way they can build affordable housing and just continue to build more through the use of the financing we provide and also the tax credits.
Something I would add to what we do. I think what we do is also unique for another reason. It's not just about building new units, but it's also about preserving existing affordable housing that's out there today. And so these properties, when they get these tax credits, they have to remain affordable for 30 years, but the developer has an option to convert it to market rate housing at the end of 30 years. About half of our portfolio today is housing where these developers are obtaining new bonds and tax credits to renovate an existing affordable housing property and then extend those rent restrictions another 15 years. I think this is an area that, people don't talk about enough. Preservation of affordable housing is equally important as construction of new real estate, because people live in these communities for a long period of time, and absent the low-income housing tax credit, there's not really a great mechanism to preserve affordable housing. And so with what we do, a tenant will live in their unit. It will go through a refinancing. The tenant unit will be renovated. They'll move out for 1 to 3 days, and then they move back in. And this continues throughout the entire property. So I think this is important for a few reasons. One is a tenant gets a new unit. That will happen at year 15, but then in addition to that, their rent doesn't increase after they get that unit because the rents are truly restricted at these types of affordable housing properties. But we're still able to generate an attractive investment return for our investors because we understand how to finance these types of deals and underwrite these preservation deals in addition to the new construction deals in the portfolio.
Thank you for that. I just wanted to say, because when you, I apologize.
Yes, I know we went through a lot of detail there, so we're happy to answer any questions you guys have. There's a lot to talk about, but I think we'll have a lot of time for that through the questions.
No, I just wanted to say, because that was one of the questions I had. When you mentioned that you're doing the renovations, that you're actually making sure that you're able to fund renovations and keeping people, because I think one of the sore spots, I guess, with real estate, when you talk about low income housing or whatever, the upkeep, because folks are there and they're almost forgotten and they stay there. And, I know historically we talked about slumlords, but I think the fact that you're actually encouraging renovations and ensuring that folks get, proper quality of life is good. So thanks for that.
Yes, absolutely. I think that's one of the strong aspects of this program. It's not an operating subsidy, but instead it's a capital structure subsidy, which lowers the cost for these developers to build these properties. But very importantly is the fact that every 15 years, there's an ability to create new capital sources, new tax credits to reinvest into an existing property. And so what you'll often see is even with a market rate property that has much higher rents, Adrian talked about rents being $400 higher at a property that has like $600 affordable rents. the property that's charging $1,000 may not be able to renovate their property kind of with the same consistency because they need to generate proceeds by raising the rents on those market rate tenants. Whereas in affordable housing, the program is designed to create proceeds to renovate and upkeep these units. And it's difficult for developers to navigate that process. And that's one area where we really help these developers. You know, with banks, it's easy for them to underwrite a new construction deal because it just, you know, that's what they're designed to do. They like taking down the construction loan. But these renovation deals, I think they really don't focus on as much.
Yeah, and for the renovation deals, it's absolutely important to make sure the tenants aren't being displaced. What's actually really happening is their units get refreshed. So they get new appliances, they get new items, just fresh coat of paint, new walls, everything. So these type of renovations are great because I think what we've seen from the renovations we've done, tenants are absolutely joyful because they have a brand new place. And, you know, for the developer and for us, we want the tenants to stay in place because they've just been proven to be longtime renters. And so that's why like our balance of our portfolio is either new construction, so new units of affordable housing, or just a renovation / preservation of affordable housing.
Yeah, I think this is, you know, an area just where the marketplace is somewhat biased. You know, I don't think the traditional institutional sources of capital really understand affordable. They don't understand the credit quality of actually a renovation deal is even higher than a new construction deal because you have an existing tenant base. They've been paying their rent for 15 years. You know what the underwriting looks like, but the marketplace is set up so that these deals are, you know, oftentimes overlooked by other traditional sources of capital. And that's why we have a differentiated view. We've done 270 of these deals. We've never lost $1 of capital in any deal because these are very stable communities. People live in their units for a very long time, but banks and other sources of capital don't understand how to underwrite these deals and how to look at them from an investment perspective.
So you spoke about being able to be attractive and, you know,
Micah, yeah.
yes. You spoke about being able to be attractive as far as making money by putting all the things in your favor, which I'm guessing takes a lot of persistence and not, if something doesn't look right, won't go your way, someone won't change their mind, it's walking away sometimes. And I'm wondering if that you've run into where you've looked at how this correlates with being green or new building techniques or anything like that. Can you elaborate on anything like that?
Yes, absolutely. You know, this was one of the things like we really wanted to cover, but like we had limited time, so we didn't talk about it. Like, you know, at ARC 70, we've really pioneered looking at these deals, not only from an investment perspective, but also from a ESG perspective as well, because many of these properties are naturally green. In addition to that, affordable housing clearly serves a wide variety of people, low-income families, seniors, people with disabilities, et cetera. But as part of the renovation process and the new construction process, these properties really improve their ability to save water, save electricity, to provide, they're able to provide services more effectively to their residents. And in fact, this is part of the regulations in many states. They want to see properties provide services, be greener than the market rate alternative. And we actually have a lot of data on this because we have so many units and properties across a wide swath of the US. But a very tangible example I can give you is, you know, we'll securitize our portfolio of bonds. And we'll do this in conjunction with government-sponsored entities like Freddie Mac. But one thing that they never thought to do was to really apply an ESG rating to an affordable housing securitization because they didn't understand it that well. And what we did back in 2020 is we took a framework that was developed by a firm called Sustainalytics. They wrote a white paper on what would constitute an ESG-oriented securitization, but we helped Freddie Mac apply that label to affordable housing and define what that actually meant. And this, you know, I think we were a bit early in doing that, but I think it's another way that we've been able to take a complicated area, simplify it for a broader investment community and access a lower cost of capital for these types of developments. And so, yeah, the short answer is we have a lot of data on that. We've done a lot in the space and there's a lot to it.
Yeah, and it's actually a part of the renovation or new construction cost because for the most part, when you apply various techniques and just focusing on being more green, you're actually saving on expenses and utilities, which is even landscaping bills. I mean, just to give one example, like in California, this was a while back. I mean, I thought it was a brilliant idea that one developer was like, we should just put native California plants instead of like bringing over the typical grass landscaping because that just takes up so much water. And that actually saved them so much like capital and they're able to go with solar. And so it does actually help that developer get more cash flow by saving on their expenses, by being a little bit more innovative on ways to cut costs and going green at the same time.
And this is also another area where we're just differentiated from the banks. You know, you go to a developer goes to a bank to get a loan and they say they're going to do all these things to the property. More efficient water heaters, they're going to put solar on it, they're going to use drought resistant landscaping, but the bank won't underwrite that because when a bank looks at it, they're going to look and say, well, this is how the operating expenses were, right? It's kind of like you going to a bank and saying like, hey, I got a new job, but they're not going to take that into account because they don't understand what your career path looks like. They're hamstrung by, you know, a lot of rules and regulations and just sort of their internal, you know, personal biases or whatever. And so this is an area that we're able to deliver value into the market because we have a large portfolio where we're able to use technology and data to then underwrite new deals and figure out exactly what the expenses will look like on a go-forward basis.
Yeah, Rodriguez, Carlton, and Price Ward.
I didn't raise my hand, but you read my eyes, huh? Okay, first of all, I want to say, gentlemen, both of you, I commend you. That 1.3 billion under assets under management, that is phenomenal. It's very impressive. I appreciate your respecting our time. And usually when you're a good presenter, and you made this so clear to us, you kept to whatever your presentation was, your agenda. And you use the word, I'm looking back on page number 3, your history, and I see right there where you use affordable housing. You were working on that then before it was the political buzzword way back then. So that, and I also appreciate so much what you said also about, you know, people, to me, in my interpretation is people don't want to be uprooted. They want to stay in their communities, and you're doing something to maintain that, you know, that foundation for them. It's all presentations were good, but yours was phenomenal. Thank you.
Thank you guys very much. You know, your time is really valuable. This is a complicated area, but this is, you know, really indicative of what we do. Like, we are able to make this happen for these developers and these communities because we are able to simplify it and make it a straightforward investment that, because this is a very complicated area, and we want to be able to do that at scale and very efficiently, which is why we really need to simplify what we do to access a lower cost of capital for these developers.
And actually, to that point, we do care about the community because it's actually helpful for the property itself. Yeah. Because so for example, like some of the properties that we've renovated, we noticed that there was a high population of children there. So we actually underwrite the amenities specifically for that community. So if there's a lot of children there, it makes sense that there's actually a robust computer center, daycare center for those children. Or more importantly, there was 2 elevators that were causing those kids to be late in school. So we want to make sure there's additional elevators so people could be able to go down and get to school on time. And there's like these little items of underwriting that we're able to do that banks don't do. But not only does it actually help the community, it just helps the property. Because of these little moves that we make, we're able to see more like 99% occupancy rates that people aren't going to move out because it's not only housing, they're also getting the amenities and the services that they need to prosper.
And even seniors don't want to be uprooted. So I appreciate, and as educators, I'm sure we all see that. Just if I may make one comment, don't take it personal. You probably heard me speak before, so you won't. I like when you said you said Adrian and I did not expect to be friends. We've been friends for 17 years. I will recommend saying we didn't anticipate or expect to have such a great business relationship. We don't like to, I personally don't like to use the word, no offense. I know what you meant. Friendship, because it's all about business and you know, so sometimes people say, I don't know, but you have a great relationship. You work very well together. Thank you for what you're doing.
Thank you very much. You know, I think this is this is something that I think is unique about ARC 70. Adrian and I are very different, but there's a strong level of respect and also a very shared goal of creating affordable housing. In addition to that, you know, we didn't want to spend too much time talking about ourselves. We wanted to give you guys enough time to ask the questions that you wanted to ask, which is why, you know, we only used about 15 minutes on our presentation, but I do want to leave you guys with the thought that we are very accessible. You know, part of the reason that we've been successful is because we're happy to answer questions and kind of answer questions directly. In fact, at ARC 70, I think one thing that's really unique about the firm is up until this point, we didn't even have an investor relations professional. You know, I think a lot of funds, the founders are not accessible. They need to work through like an intermediary. But I think what's unique about our business partnership is that we have a high level of touch and we value building the relationships with our underlying investors.
I have two more questions before we move on.
Yeah, just real quick, and thank you, Denny and Adrian, for what you're doing. Can you talk about the pipeline and how the process starts? Is it you or the developer in terms of starting the deals?
Yeah, that's a great question. I think we could have spent 2 hours talking about this one topic, but I'll try and do it in, you know, the minute and 8 seconds that we have here. So we get involved early. It's really the developer that gets the tax credits and the bonds, and they scope out the deal and kind of how it looks. But we really get involved early, and this is how we're able to make an impact on these transactions, because we're able to look at the underwriting, talk about things where a developer could make a deal better and more viable early on in the process. You know, we're not just purchasing these bonds as an investment on the secondary market, but we're the original lender. And because of that, we're able to make a real impact on these deals, but it's the developer that has to sort of put their money where their mouth is in terms of developing the transaction, and then we will lend against it.
Yeah, the reason why we're focused on that side too is because if we were just focused on, for example, being a developer, we wouldn't be able to scale to where we are now. This allows us to work with developers all across the country and actually help scale affordable housing even more. Because doing a development, you know, various developers, they're like, even the large ones, they would maybe do 1 or 10 deals a year. And so, but with ARC 70, we're able to do significantly more deals than that. That's why we have 270 deals in our pipeline that we've done historically.
I think I have a trustee online. I had a question. Was it Jackie? Yes. Okay.
Yes, I did. I know we're running out of time, but I just had a question about the geographics and what is actually, and I know it's geographically, regionally dictated. What is affordable housing based on the numbers on this map? I see you have 2 in Illinois, but your bigger states like Florida, Texas, California, you know, those that are high in numbers. Secondly, all of these are rentals, right? They're rental properties. I think the renovation is key. this is a niche in the market. I would think, because who gets renovation in an existing, unless you just have, it's just gotten so bad, you just have to have the renovation. I think that's admirable. But I just wanted to know, all of these are, to be clear or clarify, that every property is a rental property, correct?
That is correct. And every property has a contractual discount to market rate rents. And that's what allows it to be affordable. And then on your question about the geography, so we really do this at scale. We've done business in 33 different states, and traditionally we've really gone where our development partners have gone in terms of developing properties. We've done business with 55 different developers today. It's a very fragmented developer universe of for-profits, nonprofits, et cetera. But in terms of where we've allocated capital today, it's primarily been driven by our investor base. Our investor base is relatively familiar with the large rental markets in the US, but over time, we've really entered a tremendous number of new markets, and we're able to really make these deals work in many different markets across the United States.
So in Illinois, I see you have two. What type of development are those?
Yeah, so
They're in urban, suburban, where?
Yeah, so the deals that we have
you had a glitch.
Oh, yeah, let me know if you can hear me.
Yeah, so if you can hear me,
Yeah,
so the
you're
deals
going in. So.
Okay, well, I'm not sure if you can hear me, but our deals in Illinois are actually in Peoria. So we have a handful of deals, and actually it's more than, it is 2 deals, but it's multiple properties in Peoria. And so where we've been is our exposure has been in areas with heavy populations. But in addition to that is, for example, we have more investments in California, but it's mainly because we also have more investors in California that have been pushing to do more California specific deals. And so we can focus on a pipeline in any geography because we work with national developers, like developers all across the country. So we're really focused on looking for places with a substantial discount to market rent, similar to that $400 discount I was mentioning earlier. And that's been our focus, but we do see deals really all across the country, and we could pursue deals regardless of geographies.
Do you ever see yourself or the possibility of going into ownership, even if it's a condo type of a situation, in these rental units? But this is specifically geared toward rental units, correct? And keeping people stabilized and with a roof over their head in a rental unit. Would that be correct?
Yeah, that is correct. So we're focused on rental housing at existing and new affordable housing properties.
Okay. Okay. Well, thank you for answering my questions.
Thank you all. Thank you. Great presentation.
Thank you guys very much for the time.
Thank you very much. Thank you.
Because it's rent, yeah.
Okay, good morning and welcome to Chicago Teachers First Friday. With us today from left to right, we have Trustee Vincent, Trustee Washington, Executive Director Lenore, Trustee Blackwell, Trustee Ochoa, Trustee Beza, Trustee Rodriguez, joining remotely, Trustee Price Ward, Trustee Riley, and Trustee Barajas, our Chief Investment Officer, Fernando Vincents, Our consultants from Callan, Tony Lisuzo and Bernie Bazil, along with investment staff. You'll have 25 minutes to present, followed by 5 minutes for questions, and you may begin your presentation now.
Great, thank you. I'm Katie Kuga-Wenner. I am head of IR for Terracotta. Just wanted to give a big thank you to everyone for having us. Before having Ching Ching kick off, just wanted to thank you for the beautiful weather that we have today. Ching Ching, why don't you take it? Thank you.
My name is Ting Ting Zhang. I'm the founder and CEO of the Terracotta Group. It's warmer here than at Los Angeles. So thank you again for the opportunity to discuss CRE credit, a very specialized space which we have traveled in for the past 20 years. So it's going to be fun. Terracotta was founded in 2004, and we're a CRE credit specialist. We pioneered the use of predictive analytics in this space. We, in the past 20 years, we have delivered superior and stable returns for the limited partners across all market cycles. We have had no principal losses on any single investment we've made since inception. We currently manage a direct lending fund, a Terracotta Credit Fund is $500 million AUM. We're in the pre-marketing phase of the Opportunities Fund, TCOCF, with a target fund size of $750 million.
And this is turning to slide 3 now.
So slide 3, we're talking about Terracotta advantage or differentiation. I think every CRE credit firm would like to think about their secret sauces. For us, it's primarily in 3 areas. The first area is data. Data is our foundation. We have built a large data platform over the last 20 years. And the data platform provides a systematic foundation for data-driven, evidence-based investment decisioning, and also provides in our view, must-need framework for investment analysis that is more comprehensive, more in-depth, and more scientific. And the second secret sauce is for us as a team. We have an in-depth bench in CRE credit investment. We have a combined 150 years among senior members of the team. We have been investing together since going back to great financial crisis. We're not just colleagues at work, we're also friends. Our younger colleagues play pickleball together after work, and they're foodies. So it's a very dynamic and great energy at work. In addition to the differentiation of having been investing in the space for 20 years using data, we also emphasize the diversity within the team. And in addition to racial and gender diversity, we look for diversity in experiences and expertise. And we feel that there's a collection of talents in the space of economics, data science, software engineering, data engineering, really provide a wide angle lens for us collectively looking at the world more comprehensively. And we tend not to overreact. We tend not to miss things. We tend to have a contrarian thinking when need be. So diversity on the team, as we broadly construe it, is a hallmark of, in our view, of why we do well in this space on a sustainable basis across market cycles. The last advantage, the Terracotta advantage or secret sauce is a relationship. We're in private market strategies, relationship building in the industry is critical. We have in-depth relationships from the banking community. They form a robust pipeline of referrals. Over 80% of our clients and borrowers and customers are repeat customers. There's a sourcing advantage there as well. And we go to page 4. Looking at Terracotta's current strategies, our focus is the more barbell approach. For the direct lending strategy, which we'll call TCCF, it's a super senior, it's a very defensive strategy. We have a loan to value of 55%, and our leverage currently is under 30%. will underwrite each loan to withstand a deep recession. It's a super senior, super defensive strategy. On the other side of the risk spectrum, we have Terracotta Opportunities Fund, which is a thesis-driven opportunistic tackle, given the current broader interest rate environment and the broad problems on banks' balance sheet in CRE loans. So if we look at financial institutions as a plumbing system of our society, the bad loans are blockages. We look at the TC OCF as the plumbers. So we come in and to clean up the blockages so the water for finance can flow to more productive uses. And in terms of the risk considerations, that even though it's considered sort of higher risk, higher return strategy, risks are very much in the hands of an experienced investor who have gone through similar strategies, similar market times, and knows how to deal with various moving parts and quantify the uncertainties that would unfold in the investment process at the time of loan origination. I'll just use an example that we recently put under contract purchase of non-performing loan, which is secured by 12 multifamily properties as a portfolio in the Tenderloin area of San Francisco. Because of bias in the broader market against whether that area is investable, this portfolio, they're really workforce housing. That could represent great opportunities. In our data analysis, we realized that the demand for workforce housing priced at a reasonable entry point, they're very hard to come by. And the recent COVID impact on the demand in San Francisco actually has been primarily impacting Class A multifamily properties as many mostly young urban professionals in the tech space moved out of the city. In the Tenderloin area, where people who the working class, the hardworking people who are not making the wage to move to the East Bay have a great demand for these type of rent-controlled apartments. So buying these assets at about $133,000 a door, when the replacement cost is in San Francisco nowadays probably $750,000 to $1 million a door, really builds a great defensive basis. But at the same time, because the basis we're buying at, we'll be able to keep the rents low and allow people who work in the city living in the city. So just to emphasize on the Opportunities Fund, we call it a high return, high risk. The risk is really it manifests as uncertainties in the investment process, which can be quantified and analyzed in the process. Next page is just a quick summary of our track record in the last 20 years. We consider ourselves as an all-weather shop. In the last 20 years, arguably, it's one of the most volatile period for commercial real estate credit. We have consistently outperformed peers in the execution of a variety of investment strategies. We have originated CRE loans as lenders. We have invested in opportunistic credit. We have bought NPL and REOs from banks. And we have weathered a variety of economic storms. We went through GFC. We went through the retail debacle as a result of the e-commerce challenge. We're dealing with and looking at the stress in the office sector. We invested when the interest rate was 0, when it was 1%, 2%, 3, 4, 5%. We have invested in years when the properties were increasing 20% a year. We have invested in years when it was tanking 30, 40% a year. So I persisted, and we have never incurred any loss in any single investment that we have made. Next 2 pages touch upon the portfolio constructions of both the direct lending fund and the Opportunities Fund. When we invest across market cycles, across risk spectrums. We have a certain philosophical view about portfolio construction. And primarily, the components we pay special attention to are the market cycle, interest rate cycle, leverage, diversification. The way how we think about the portfolio construction have historically led to superior and stable returns. For each portfolio, we wanted to build a recession-proof portfolio. The way to execute it is really at each investment, we underwrite and try to size a loan to, we call it the worst case scenario, a deep recession, or quantitatively a recession of a third standard deviation. And then we have a quantitative models stressing the investment scenarios based on a variety of macroeconomic shocks, other stresses, scenarios that are inherent to real estate credit. And in addition to the market cycle, we look at interest rate cycles. We think about interest rate environment when it goes up, when it goes down. For TCCF, they're all floaters with a floor. So that hedges the risk when the interest rate goes down, and we capture this opportunity when interest rate goes up. And that thinking relates to leverage as well. We tend to believe in conservative leverage at the asset level instead of at the fund level, where the leverage risk is segregated from the rest of the portfolio. Given the TCCF's intent to be a super senior, super liquid portfolio, we originate short-term loans, and we also build various mechanisms so that the portfolio could be wound down in a very short period of time. Diversification, of course, we look at diversifications across property asset types, across geographies, across various borrowers and guarantors. Next page is on the Opportunities Fund. We have a similar approach with certain customizations here. We have a recession-proof mechanism of buying at a basis that is, when adjusted for inflation, at a historical low. That's a big risk management on our part. And interest rate cycles are thought through. Even in today's environment, we're still at a certain points of uncertainty. So we would consider rate insurance to manage interest rate up and down. We diversify and we apply conservative leverage at 50% or less. We focus on location in this portfolio, which is a hallmark of our investment. Each investment asset is secured by a property in a top location. This is the same with the Opportunities Fund as well as the TCCF. And then we get to the data pages. We wanted to spend a few minutes here because this is what we feel is critical to our advantage. Don't let the simplified graph fool you. It's actually very complicated, very hard to build a larger data warehouse. It took us 20 years and a team of very talented people. So on the left-hand side, so this is a type of data that we collect. From the bottom, we call it layer cake. This is 7-layer layer cake. And we tend not to focus on the tip of the iceberg, which is a top layer, which is a real estate transaction. Those are the comps. We feel the comps are driven by fundamental drivers and economic and social factors. We want to understand them before we come to conclusions about investment. So the first layer from the bottom is the earth. We use the NASA data to look at the entire country, both in terms of the geography and topography. And it's a great drivers of demand, and why Chicago is a major metro. It's never accident because the waterways, why New York is New York, why LA is LA. Earth makes it determines a great deal of demand. And people tend to want to move to areas that are livable, and there's water, and there's various studies about the significance of the earth. And the second layer is a human infrastructure. So we have input, all major infrastructures. We know that major roads separate neighborhoods, and we know that transits provides the impact on pricing. In transit-oriented economies, access to transit is a positive for asset pricing and sustainable asset performance. And on top of that, we have data from all munis and counties from the country. There are about 155 million assessment records in our database, which we consider as a comprehensive property fabric of all residential and commercial properties in this country. And on top of that, we look at businesses and jobs. Job creation is a big driver of demand for real estate spaces. The Tesla opened a plant in San Marcos, which is a tiny town in Texas, that would have changed the demand dynamic drastically. Then on top of the business and jobs, we track population movements. These are cell phone data. We'll look at credit card data regarding business activities. And we understand through USPS delivery routes, where people are moving to, where they're moving away from. So these are the human fabrics that underline the transactions. And above that is the demographic and socioeconomic data. So we get data from US Census, that's once every 10 years, American Community Surveys once every year. And they really form the consumption base for retail assets and why people tend to live in certain neighborhoods. And on top of that, we have real estate transactions. These are lease comps, sales comps, and finance comps. When we have 10 terabytes of data, we connect them and harmonize them. Then we start to put various methodology and algorithm to try to read the data, try to get investable insight out of the data. Among others, we use economics, urban economics, and just old-fashioned real estate investment experiences as underlying methodology. And we know that there are 200 variables that drive property performance from a value point of view and from cash flow point of view. We use algorithms, including quantitative methods, classical regression models, machine learning, AI algorithms to really parse through data to understand not just what is going on today, but what's going to happen in the future. And finally, there's a technology connecting them. There's a data governance. We need to make sure data is clean, is accurate for our analysis. And they support our underwriting, our due diligence, and portfolio monitoring, and market tracking to make sure we stay ahead of the trend as opposed to reacting to the trend. The next page is our team. We have, over the last 20 years, built, in my view, an incredible team of talented professionals. Investment team on the right-hand side are responsible for investment decisions. They leverage the data platform we have already built. From time to time, they have questions on the data side. They would interact with our real estate data scientists, think tank, think macro problems, and the feedback can get feedback from investment teams. On the left-hand side, data team is our talented data engineers and software engineers to put this whole thing together. So the decision-making is quick, certain, and more scientific, more comprehensive, more in-depth. So overall, we feel that in the last 20 years, and because we have taken our time building a real estate credit shop, and we feel that team that have the experience in making investment decisions across market cycles. When collaborating with a data team with the wide angle lens, looking at the world, along with the relationships we built over the years, are really three secret sauces for us to succeed.
Thank you.
No. No, I didn't have a question. I was just signaling. I thought there was no question.
Thank you for the presentation. I'm going to make a confession. I fell for the hook for the Opportunities Credit Fund on page 4. When you say we're about to see a market opportunity in distress, not seen since the GFC. I was wondering if you could just elaborate on that and if you think it's only office, primarily office, or broad-based.
Yes, there are a few macro drivers for the distress. Office is obviously what is in the headline news. What we see is we have a large maturity walls of loan maturities coming in the next 4 years. Each year, we're looking at $300 to $500 billion loan coming due. And banks are currently making, based on Federal Reserve data, making $5 to $10 billion a month in origination. So there's not enough capacity to absorb the loans coming due. And across asset classes, multifamily, even though it's a fundamentally sound asset class, we have a shortage of housing, but the loans were made in the past 3 years tend to be oversized because we were in a different cap rate environment. We were in a 3 to 4% cap rate environment when interest rate was 0. Now interest rate is 5% the Fed rate. So that fundamentally changed the cap rate and depressed the real estate value of multifamily assets. So there are broad-based distress when it comes to real estate credit, and especially at regional and community bank level. There's the upcoming maturities. There's a lot of real estate loans are non-performing. Given the interest rate environment, borrowers find it hard to catch up with the payment. Rents don't grow 5% a year. We're actually now 5%. So our interest rate really went from 0 to 5% in a matter of less than 2 years. And the rental growth is 3%. So the distress is caused by the broader interest rate environment, and the distress is primarily with community and regional banks. And we get calls from bank relationships, the chief investment officers really looking for solutions. And also the talent base is gone. The guys who manage the special assets during GFC, most of them retired. So there's a talent drain as well. And it's a thesis-driven investment. And we invested successfully during the GFC days. And some assets looking back, at the basis we bought during the GFC, and we never saw them again. And this portfolio of multifamily rent-controlled apartment buildings in San Francisco, buying $133,000 a door, we probably won't see them for another 10 years. So it's a very macro-driven. Office, obviously, is asset class is very troubled. It's driven by 2 macro factors. One is the remote hybrid work culture, still in the process of developing. The dust hasn't settled yet. And that would fundamentally change the demand for office spaces, and we're watching it. And in addition to that, we also have had an oversupply of office space for a long time. And one of our data tracks the number of employees per 1,000 square feet, and it's becoming more and more efficient over the last 15 years. So definitely it's not overnight. COVID was a trigger. Office has been oversupplied for 15 years. So that's the asset area that we're watching. We're not diving in with the eager and enthusiasm buying distressed debt as we're still waiting for the chips to fall.
Yeah, trusting the raw assets. Thank you. Thanks, sir.
Hi, can you hear me? Can you hear me?
Yes, go ahead, Paula.
Yeah. Okay, I wasn't sure if I was called on. I couldn't barely hear. I just want to say that I actually was really hooked. You did a very good job talking about your data analytics and how it's driving sort of what you're doing. So thank you so much for that part. And I really like kind of your, I'm not going to say cautiousness, but the way you're looking at the distressed commercial market right now and not like fully trying to jump into it, but watching it. So I really appreciate those 2 parts of the presentation. Thank you.
I appreciate the comments. Thank you very much.
Go ahead.
Just as a follow-up, one of the weird things that people kind of forget about the GFC is even though there was, $1 trillion of wall maturities, 09, 10, all coming due, and the wall of worry, they were able to get through it, blend and extend. That won't work now because we're in a completely different interest rate environment. But a lot of things didn't transact because we were able to get through that, pray and delay and the whole 9 yards. Do you expect this to be different then? Do you expect like actual distress sales to happen in volume, basically coming on the market?
Yeah, that's a great question. I think what we call in our industry extend and pretend. So I think that's usually banks the first line of defense because when problems happen at scale during GFC and today, it's just not enough a reserve bank has to deal with all these problems. You can't write down a huge number of assets overnight. And some problems do resolve and some don't. So we feel that this time around is very similar to the very beginning of the GFC in certain aspects and very different in others. The similarity is that in the beginning of a large scale distress, we do have these conversations with banks for a long time, and they want to sell an asset and they don't want to sell the asset. They want to sell it, they're not getting the pricing they wanted. So this is San Francisco portfolio is a conversation over a span of 6 months. It's every quarter the appraisal comes in saying otherwise than they thought. And we have a very collaborative relationship with banks. We're not just trying to buy debt at a deep discount and foreclose out everyone. So our approach is really giving bank advice as to what the asset value is and what the asset value would be in the coming years. And the bank doesn't have the time to hold on to them. And with this San Francisco portfolio, once we have a preliminary dialogue with the borrower, so more likely than not, the buying at a discount at a basis that's defensible actually would allow us to continue to have these assets serve as rent controlled apartment at the basis where tenants can afford. So because that's where we're coming from, and we're not trying to hide that asset value, we tell them very candidly that in 5 years, in 10 years, this is probably $1 million a door, but they don't have 5 years or 10 years to hold on to. So the conversation, with the large portfolios, we usually get a tape. We're not buying like 1 or 2 during the GFC. We're not buying 1 or 2 a month, and all of a sudden just sped up. So we see that the similarities there. The differences actually, I think, is more optimistic in this climate. During the GFC, it was a demand problem. It was when we bought some of the distressed notes on retail assets, there was no demand for retail spaces. Even the properties, we didn't lose any tenant. We're not able to lease out the space that was vacant. There was just no demand. And today is a different story. I think the stress is in the capital market, it's the interest rate environment in finance, not necessarily in Main Street when it comes to multifamily or the shortage of housing. When it comes to retail neighborhood shopping centers, the grocery anchored, the vacancy is really low. And in retail space in particular, it costs about $450 a foot to build, and you can buy it for $250 a foot. So there's a meaningful barrier of entry. So from a Main Street point of view, it's actually a really good time to reposition the asset. And we had a significant experience in doing it. And going through GFC, we felt that the team really grew from researchers, economists, and data scientists, and peacetime generals making credit decisions from behind the desktop to really to wartime generals knowing how to reposition asset, how to make investment work out and solve problems. Does that answer the question?
Some more? Okay. Thank you. Thank you for your presentation.
Thank you, everyone.
You didn't have a quorum present, so that just, sorry.
No, I was just going to summarize and point out a few observations. I think what you've seen here is definitely a variety of managers that dabble both in commercial and residential real estate. I think that's the point that I was trying to make earlier, that you're seeing a lot more new managers incepting. They're coming out of larger organizations and focusing on niches. And the more I think about it also, I think in the pacing study, we've identified potentially a search later on this year. Our pacing is not at the large numbers that we used to be. But given the size of these funds, 400 to 750 million raises, we actually, our smaller dollars may actually have a bigger impact, and we may actually have a better seat at the table rather than parking it with a much larger fund that's raising 15 billion, and our 30 million is really a scratch versus some of these funds that it's going to matter are, with what we're bringing in, both the name and the size, to validate their thesis and their firms. So that's just my observations.
Just a couple observations. For those of us who remember, there used to be American National Bank and there used to be LaSalle National Bank. Those aren't here anymore. This is the new banking industry. And what I love as an economist is things take a while to adjust. And during that adjustment period, there's opportunity to be a good investor and a thoughtful investor. And I think that's what we're seeing. And that's what we saw with this across a variety from classic middle market lending to some structured credit and doing some interesting financial engineering. The banks don't want to do it anymore. Other people are doing it. That's creating this opportunity. So I think it's a great time to look at all of these and to really get our hands around the space as we're looking at private credit soon as well. So there are a lot of good opportunities.
Hi, this is Bernie Bazile from Callan. I'm connecting in via Zoom, and to build on what Fernando and Tony also mentioned is that each one of these groups also demonstrated the importance of risk management when it comes to, of course, investing overall, investing within real estate, and then also investing within real estate debt. So that's also just a very important component as to how to create effective portfolios that are additive to your, to your overall portfolio, but also risk management is essential. And that seems to be a theme with each one of these managers, and they sort of displayed how they would go about managing risk. So that's sort of an important theme that really came out today with all our presenters.
So how did you select these 4 managers that came in today? I mean, did they reach out to us first, or did we reach out to them, or?
No, it's I'm trying to think. Maybe one reached out, one I met through a conference, one.
You met one what?
Through a conference. Another one came through Callan, and then another one came through a reference. But so Donna with Ka Capital used to work at Loop, and she actually, her firm, another foundation invested in them recently and recommended that they come speak to us. So it's been a hodgepodge.
Yeah, because I did see there was, like you said, there was a variety in on one. Which one did Loop Capital?
So Donna was one of the founders of Loop Capital. She's no longer at Loop Capital, but she's one of the earlier founders.
Right.
Of
Which
Loop
one did they or have them reach out to us?
So they were recommended by the Joyce Foundation. The Joyce Foundation invested in Ka Capital recently. The one that reached out, cold call, I believe, was Caro Investors, the first woman.
Okay.
She also, again, I don't think I had interactions with her before, but in some of her predecessor firms, I knew those firms, but I didn't know her specifically. And
well, like you said, there was a variety, and that's why I thought it was so interesting.
Right,
It was interesting.
right.
Yeah. You had a good cross section. What's out there?
Yeah.
Thank you.
So the last group of managers could have been the lack of caffeination, but I thought, looking at their stuff and listening to them, that their best proof of success was their track record. versus, I mean, they're obviously analytics, right? And just looking at all that, but proprietary, all that. So you get to see some images, but so would you agree that it's really their track record that shows them and their experience, but versus what we heard today?
I would say, especially with a firm like that that does have the track record and they've got a significant infrastructure, that you can say, how do I believe they'll do well going forward? Track record, plus they've got the people there that are executing on this strategy. So that's a good way to think about it. No matter what their presentation was. But the key then is, okay, the track record, we can expect this. What are the things that created that? Was it a great environment? Are there any risks that we need to look at? And those are the things we'd look at next.
Yeah, because that track record wasn't amazing.
Yeah.
I mean, yeah. So just to build on that is, that's something.
Well, and that's part of, some of the stuff that they're doing is taking stuff off of banks' balance sheets that's been sitting there because they don't want to take it over a year, right? So they have to get rid of it. And that's, a lot of that has been going on during this period. So a good environment, but yes, exceptional track record.
I will say that I I like all of what we heard today, and I think that it is all something that I think would be very appropriate for us to be getting into. And I think of like the affordable housing stuff, for example. That's something that that's something that some of our stakeholders have been pushing, just even within our own city and everything. How can we be building upon that? So I think that looking at those types of assets to really invest in that, and the mortgage thing, now that was ding, ding, ding for me, like, because I wish that more of that had been around 15 years ago when people were losing everything, and having to restart and rebuild. And so as a fund, a public fund of educators whose students and families are directly impacted by these types of things, I hope that we can figure out ways to steer our resources into those types of investments that really will have, I mean, of course, we got to make our money, but how can we do it in a way that's going to be not just financially amazing for us, but how are we going to make an impact and blaze a trail for others to follow suit? Because I heard what she said when talking about, making the investments, and it's, they got to have the resources to do it, the funds, and the funds matter. Like, they've had to turn business away because they just didn't have the resources to do it. So yeah, I appreciate what we've seen and heard today, and I'm hopeful that we can get more details on some of that.
Go ahead, Jackie.
Okay, I just really, I appreciate, again, the variety which has been brought up. It gives us a lot to look at, and we do have to have some renters, but we need more than just renters. We need affordable housing, and we need people to stay in their homes. Then we have to have this if the public education system is to survive. More and more families are being forced out of the city where we work, where this pension fund is a pension fund of teachers, educators, principals. And if we don't have the population, I think we need to start thinking about this down the line. We don't have the population. We don't have the teachers, because there will be no need for teachers. And then we got to look at teachers leaving the system. If we don't have affordable housing, where will people live? What is the incentive to stay in the city and be able to afford a place to live and survive on a teacher's salary. I'm not saying that it's anything about the salary, but I'm saying that certain job titles people can't afford housing. So those would be the ones that have to rent. I think we got to look way down the line in this new banking system. Just like Tony was saying, guess what? LaSalle is no longer. Okay. Many banks will probably end up in that situation. So this right here is a new way. And we need to think long term, and that's just my perspective, long term on how we can have an impact on creating or investing with to generate affordable housing. And that's from every level. So I think we just really need to put a lot of thought into this, and as a board, as a trustee board, and try to gauge, what's to come, so that we have students and teachers and a population that can sustain Chicago public schools and other schools, but specifically those that are a member of this pension fund. That's it for me.
Thanks, Jackie. Tammy?
Yeah, and to the point, Jack, I agree that long-term we need to consider real estate investment. But so I guess strategically, would our goal be to increase the 110 million that's already invested, or would it change the allocation? What would be a recommendation, I guess, moving forward?
No, we wouldn't be actually recommending an increase in allocation. I think the pacing that Callan brought in last year would allow us to maintain or what we call vintage year diversification, but also at the same time identify new managers, new strategies. Because again, we're not putting out large dollars, but at least we can entertain smaller strategies like this, especially given the environment. But I don't foresee us necessarily increasing the allocation total.
Right, but you're saying just to look at, I guess, diversifying, I guess, or bringing in more, that would be a good time to do that. Okay, all right.
All right, thank you. So just, I guess the meeting's over.
Thank you, Jeff. I appreciate you standing in and chairing the meeting for me. Excellent job. Thank you so much. I appreciate it.
Thank you. So we got 29 minutes.
Do we have old business or new business? No?
No.